Welcome to the second annual C4I conference. Long overdue. You got to look around the corner and see what the threats might be going forward. I've tried to do in this administration, make sure all of our different departments work together. Andy Mais running insurance, Katie Dykes running energy and the environment, putting them together with the very best academics and insurance experts we can as we think about the threats of the future. Obviously, flood, mitigation. We're putting tens of millions of dollars there. I want to work with the insurance industry to make sure that we're doing that in an appropriate way. We'll also worry about drought, what that means in terms of food supply, what that means in terms of fire. Make sure we're prioritizing our efforts in a way that coincides with what insurance says will keep us safe. I look at places like Florida and Texas and Southern California. I'm glad we're in Connecticut, but we got to do better. Thanks for being here for this conference and working together, public and private, hand in hand.
Hello. Thanks for having us here at the Connecticut Conference on Climate Change. We're super excited about being here. Brief introduction on my side. My name is Jigar Shah. I'm the director of the Loan Programs Office. And with me is my partner in crime, who's the head of our risk division, Andrew McCabe. If you want to introduce yourself, Andrew.
Yeah, thanks, Jigar. Andrew McCabe. I am the Chief Risk Officer, Director of the Risk Management Division of the Loan Programs Office here at the Department of Energy, and super excited about being here as well with the Connecticut Conference on Climate Change and Insurance. I'll go ahead and just start us right off. We're going to ask some questions of each other and challenge each other a little bit. Hopefully on this Friday, we have everything wrapped up. So what role, Jigar, what role has LPO played and can play going forward in addressing climate risk?
Yeah, look, I think that, at the very top level, the money that came out of the Inflation Reduction Act is, depending on which numbers you believe, is, let's call it, $370 billion. And it's supposed to inspire $10 trillion of investment, right? And so by definition, the Loan Programs Office is in charge of making sure that the first of a kind projects get deployed, the engineering excellence projects where the EPC companies do the second, third, and fourth projects. We want to, keep funding incremental innovation as the costs come down. And then finally, we want to help Wall Street really do the first securitization so we can get full Wall Street acceptance. And when you look at our track record, we're the office that supported Tesla, which today, of course, has inspired, I think, every automotive entity in the world to embrace electric vehicles fully. And so we played a very small role in that. But, clearly Tesla played the much bigger role in that. But we're very excited for them. We also put the first $5 billion into utility scale solar and utility scale wind projects in this country in the 2009 to 2011 timeframe. And many Wall Street banks will say that they would not have provided senior debt to that asset class if it hadn't been for us going first. And many insurance companies, of course, are also invested through their funds into these asset classes. And so when you think about what it means to build a bridge to bankability for these assets, the Loan Programs Office is the main tool by which the commercial banks and others get comfortable with these additional assets. And when you think about where we are today, we probably have electric vehicles, solar, wind, some geothermal, some lithium-ion batteries that are fully market accepted. But there's another 20 sectors to go. You got sustainable aviation fuels, you got nuclear, you got, next generation transmission technologies, hydrogen, carbon sequestration and storage, and the list goes on. And we've got, 90 some billion dollars worth of loan requests into the Loan Programs Office across 91 applications that are active. And so that's roughly $1 billion per application in the office. And so we've got another pretty steep hill to climb. So I think that's probably on the first side of things. The second side of things, though, is that, our loans are probably 25 to 30 years in length and at maximum, and some of them are shorter. So, the security of our projects matters, like in terms of, is that location in the middle of a floodplain? Is it likely to get flooded out regularly? Is it going to be affected by sea level rise? Like, are we going to have some of these other issues? And clearly we can't protect every single project from, a hurricane or a tornado or something.
Sure.
But we do have to think long term about these assets. We're managing, roughly $30 billion of the projects now in our portfolio management group that, are probably 10 years into their loan and probably have another 10 years at least left on those loans. So, I think there's a lot of reasons why, we need to be cognizant of climate risk, both on the macro and the micro. So, but at this point, Andrew, I'll flip the script over to you. You're LPO's chief risk officer. Can you talk to us about how LPO assesses climate risk?
Sure. Thanks for that. Let me talk first about the overall LPO context in both addressing and assessing climate risk. Throughout its history, LPO has been about enabling those technologies to allow for more efficient and less polluting generation and use of energy, whether deployed into innovative vehicles, as you pointed out, or through advanced power plants and infrastructure. Our Title 17 projects, as you'll see if you visit us on LPO website, must avoid, reduce, or sequester greenhouse gases. And our ATVM program is Advanced Technology Vehicles. Manufacturing program is similarly explicit in its requirements that finance projects use a lot less of the stuff that produces greenhouse gases. The just launched, and this is a mouthful, Carbon Dioxide Transportation Infrastructure Finance and Innovation Act Loan Guarantee Program, we know it as the CFIA program, supports carbon capture, utilization, and storage technologies that helps haul the bad stuff away. And the context here is that LPO addresses climate risk by going way past acknowledgement and invention phases, if I can call them phases, to the tangible support of decarbonization technologies through the provision of debt capital. So assess and mitigate and lend when there's a reasonable prospect of repayment. The business of assessing climate risk here is reviewing new prospective loans and loan guarantees and our existing portfolio for their roles respectively in decarbonization. How might these loans help promote the reduction in climate-related risk events? And also important to note, just as it's almost an aside, but not really for our audience especially, is our ERM team also assesses known risks to which LPO itself is exposed. And, just for good order's sake, of course, we do report that up to DOE's Office of the CFO yearly. So on from the LPO context to the degree to which projects themselves are exposed to climate risk. And so how do we do that? And Jigar, feel free to chime in or.
Well, one thing I would say before we hit that topic is just to maybe describe all the additional authorities we have, right? So when we came into office, we came in with $40 billion of remaining loan authority. So that's across, as Andrew suggested, Title 17, the Advanced Technology Vehicle Manufacturing Program, and the Tribal Energy Loan Guarantee Program. The Inflation Reduction Act gave us an extra $100 billion of loan authority, roughly, across those three existing programs, right? So $40 billion for Title 17, $40 billion for the Advanced Technology Vehicle Manufacturing Program, and then increased the Tribal Energy Loan Guarantee Program from $2 billion to roughly $20 billion worth of loan authority. In the bipartisan infrastructure law, we got this program called CFIA, which is to fund CO2 pipelines, particularly trunk lines that might be common carrier. And so there's a tremendous interest there, and that's probably $25 to $30 billion worth of loan authority. And so we're busy there. The bipartisan infrastructure law also expanded our existing authorities to cover more sectors. So the Advanced Technology Vehicle Manufacturing Program was originally just passenger vehicles, but today it also includes heavy trucks, medium duty trucks, airplanes, locomotives, maritime, and even the Hyperloop. So if that becomes a real thing, then it'll cover that as well. And so, that's a lot of work. It also expands our remit in critical minerals in Title 17. And so that's great. And then gives us the ability to access the federal financing bank for the Tribal Energy Loan Guarantee Program, where previously we were only able to provide guarantees to banks. The last new program that we got was the 1706 program, which is within the Title 17 family. And that really allows us to help with existing energy assets, right? So it's called the Energy Reinvestment Program. And that allows us to take existing coal plants, natural gas plants, and help them make the transition to becoming useful assets for the next 60 years. And so that includes getting property taxes to continue to get paid to local towns, as well as keeping a lot of the workers employed that are there now. And that extends not just for those power plants, but also for all electricity infrastructures. That includes transmission lines and others, but also includes things like nuclear plants and helping to repower or extend the life of those nuclear plants. But then it also includes a petroleum supply chain. So things like tank farms or refineries or old pipelines that are currently being bypassed because more pipelines have been built. And so there's a couple of applicants that have come in where that particular natural gas pipeline or oil pipeline is no longer essential, and they're going to repurpose it for CO2 or hydrogen or ammonia. So a lot of new authorities, and that authority, the way that one works is we provide loans at U.S. Treasuries plus 0.375 of a percentage point, and then we might have a risk-based charge on top of that. So pretty attractive rates, and then we can go out, probably 30 years. And then we pay the credit subsidy on, above a certain interest rate. So if you have really risky projects, we pay for the points on the loan as you were. And we have $5 billion to pay the points on the loan. And so once that $5 billion is out, then we run out of authority there. And I'd say even in the riskiest of projects that we would be willing to underwrite, that number doesn't usually get above 10 or 12%. And so even if we only do risky projects, that $5 billion probably translates to $50 billion with the loan authority. And then if we do a lot of low risk projects, then it can be much higher with a cap that Congress has put on us of $250 billion. So we'll see whether we hit that cap. But we're excited about all these new programs and getting the private sector, frankly, to apply for them all.
Yeah, so that's definitely the LPO context. There's a lot of context, a lot of programs there, and a lot of new authorities. So we're all busy from originations to risk, and moving onto the climate risk, and to the degree to which we look at climate risk and how do we assess it, and what do we do with that? Well, we look around, we look for best practices. We look at our colleagues at Standard & Poor's, credit rating agency, and our SRO. They use 4 criteria in assessing projects: physical risks, climate transition risks, natural capital, and waste and pollution. And physical risks are those risks that are directly related to climate, right? So susceptibilities to drought, like Jigar mentioned. We've got up to 30-year loans here. We have to look at those risks: sea level rise, flooding, seismic activities, windstorms, et cetera. Climate transition risks, another bucket, is the project's exposure to potential future climate-related changes in regulations, changes in consumer demand patterns. Natural capital, does the project depend on non-renewable, scarce materials or hard to obtain renewable ones? And thinking also about the impacts on the environment in obtaining these materials. And then the fourth S&P bucket, if you will, waste and pollution. Do the projects themselves, are they subject to or even cause pollution themselves? Factors are there factors that bring out waste products, wastewater, other pollutants? We do have teams that have looked at this. It's been pretty much in our DNA since day one. NEPA reviews, our engineers looking at the wastewater and the treatment and in the permitting process. But we're bringing it out over the last 10 to 15 years. It's really the climate related risk, ESG, has really come out and is really developing, as I'm sure this audience is very much well aware. Fitch, another credit rating agency, introduced ESG relevance scores, which I thought was interesting because in some projects, they might not be as relevant depending on the type of loan. The point here is that there are growing numbers of other reputable guidelines for mapping in environmental factors, such as MSCI. They produce indices, the debt indices, UN principles for responsible investment, the Government Finance Officers Association, and most, if not all, other credit rating agencies are looking at this. And getting to LPO, we incorporate a montage of these, and we also have our own lessons learned. As we've said numerous times, we have we're buy and hold largely, and we have one of the largest innovative innovative energy debt portfolios around. And so we've learned a few things as we've gone through this. Ensuring our own portfolio managers share these observations that they've gained with our new transaction teams is pretty critical to our operation. Just as an example, the fires and droughts in the western half of the country have certainly been on our minds. Historically, at least, LPO has been predominantly buy and hold, as I mentioned. And so we do get to know the point is we do get to know our credits pretty well. We also have, just because we're Department of Energy, national labs. We have, as I mentioned, our engineers, in-house engineers, NEPA review staff. And so we're pretty well staffed to handle and manage and assess and mitigate climate risk as we originate and on the run with the existing portfolio. What do we do with this information? Just more on kind of that montage, screening and scoring, integration of the E and ESG. That was a subject of an internal study that we did in February as to how to do that most effectively. We have, just like credit rating agencies, risk matrices that we put loans through as we evaluate the risks of transactions. The presence of climate risks can translate into, say, a higher debt service coverage ratio or the need for special reserve. We consider the science with our staff engineers, who are some of the best in the business, best in the world, and ask the what ifs. And in some instances, our risk group will go back and ask for additional stress cases to be run by transaction teams accounting for climate risk observations. What happens, for example, when a solar facility suddenly would have no water on site? Climate risk translates into other risks that I would say, quote unquote, traditional matrices catch. Lack of water, for example, is an operational risk. These changing views can adversely affect regulatory and legal risks for sure as well, just different traditional risk categories that we've looked at. But again, we're really trying to bring the E out on ESG here because of changes in the world. The focus on climate risk has changed, driven in part by the climate events, as I'd mentioned them. I haven't studied them extensively, but I think this group would appreciate that these 100-year weather events seem to be happening a lot more frequently lately. And that's meant to be my kind of a probabilistic joke, attempted humor. And also, Fitch pointed out recently in a white paper, the inverse relationship between credit default swap spreads and ESG scores. So investors are really looking more at ESG as a tool to identify risk, which helps make LPO programs more interesting, I think. And with that, Jigar, let me pass it back to you with a question.
Sure.
What role can the insurance industry play in addressing climate risk, and what synergies are there between LPO and the insurance industry, do you think?
Yeah, no, it's a great question, and one that, look, I think the insurance industry has played a very key role in this area for a very long time, starting with our friends at Swiss Re and others who've been working on this for 15 plus years, but then many of you in this room who have spent a lot of time thinking about how you insure against many of these risks. And so that, I think, does tend to play into, how we should build infrastructure. The other area, though, is also around your investing side of things. Insurance companies have long invested alongside of LPO and others in energy projects. And I know John Hancock played a pretty big role in a lot of our projects in our first phase from 2009 to 2011. And I think from what we're hearing in the news, many insurance companies are looking to expand their risk profile to try to get higher yields today. And so when you look at who has the best track record in the industry today, it's probably us, right? And so when you think about all the early stage things that we did back in 2009 to 2011, we did things that, most folks thought were risky. But in the senior debt tranche, we were able to, really have a loss rate of roughly 3.3%, which is really low.
Absolutely. Yeah.
And when you think about how much money we've made for the government, there's a couple pieces here. One is that we earn roughly $533 million of interest per year. We've collected roughly $4.2 billion worth of interest payments so far in our portfolio, with $1.07 billion of losses. And we've got another, 10, 15 years left on our average asset. So, you can imagine there's probably another $5 to $7 billion coming in of interest there. So I think the returns have been quite good. I think the losses are frankly in line with where most commercial portfolios are. And so part of what we're seeing is an interest from the insurance industry to co-invest alongside of us. We have a dual process where we have a conditional commitment that we provide first to our applicants, which is basically a glorified, 35-page term sheet. And then we actually then have the closing, which is them closing all of the conditions precedent, but also, the legal documents with us. And so between those two time periods, the existence of the applicant becomes public. And for many of our applicants, they've said, look, actually, once we go through this process and have the stamp of approval from the Department of Energy, they'd be interested, even if it's at a slightly higher interest rate, to bring in maybe half the debt from, the insurance industry or others, so that those industries are doing due diligence on the deals and actually coming in to these projects. And it provides that bridge to bankability to the next projects that this developer invariably will have to build. And so getting the attention from and the respect of, these institutional investors, which the insurance companies are clearly at the top of the list, is very important. I'd also say that there are some very specific risks that we're taking that an insurance industry might be able to insure against. We're not really allowed to buy insurance to take care of those risks, but our applicants are. For instance, many of our projects have merchant risks alongside their projects, whether it's on hydrogen or whether it's on carbon capture or other things. And you could imagine insurance products being available to help collar some of those costs in the marketplace. So we're pretty excited about that. So my next question for you, Andrew, is that, we're just one loan program within, the federal government ecosystem. I'm curious, you work with a lot of your colleagues throughout the U.S. government. Maybe talk a little bit about the governance structure we're under with, with FCRA, which I always forget what that stands for, and then all the other lending institutions, as well as the role the Office of Management Budget plays, and some of these connective tissue, maybe with some of our brother and sister lending agencies.
Yeah, sure. So as you know, Jigar, I've had previous experience with Exim Bank and WIFIA, which is the EPA program, and their experience is similar, where they see themselves as serving as having a multiplier effect, where they'll bring in capital, but they're supporting industries. In the example of WIFIA, supporting the necessity of modernizing our water infrastructure programs in the United States. EXIM supporting exports and basically acting as an engine to spur on business, to further commercialize business. We're at the earlier stage of commercializing business. But in terms of the overall federal credit infrastructure, I mean, we have a substantial amount of loan authority and the multiplier effect, which Jigar talked about. The Office of Management and Budget works with us. They are the overseer of credit subsidy calculation, which is in effect the cost to government of cost of carry of these loans to government. And so we work hand in hand with our partners there. Treasury as well has a role with some of our programs, and obviously as a provider of the financing through their federal financing bank, through because we don't have the actual bank within Department of Energy. There's no teller window here that we work with Treasury, and they also provide some insight onto the risk that we undertake on certain of the transactions depending on the program. But I think that answers the question. We have a very large infrastructure here supporting basically the administration's goals to decarbonize the economy and on the 4 pillars schedule. And it's growing. We're united through several pieces of connective tissue. That sounds disgusting. I should figure out how to say that a little bit better. But Federal Credit Policy Committee unites different elements within Washington, the federal credit community. So we have contacts with our colleagues on how best to address risk across government in USDA, and expanding out to farther reaches such as HUD, the DFC, former Overseas Private Investment Corporation, transportation, and commerce. Commerce has a new program very close to our programs, or some of our programs, called the CHIPS program, and they've got some new authorities that they're looking to deploy. So it's a growing business beyond the shores of LPO, but the risk managers here are talking and trying to divine the best practices in conjunction with industry, in conjunction with our credit rating agency colleagues, how to assess and contend and manage climate risk and incorporate it into the risk matrices. And not just, I think the point is it's not just at LPO, but across federal credit. And there are going to be opportunities for insurance. There's nothing more exciting to a risk manager, Jigar, than hearing risk sharing. And growing the opportunity to not be the only one in the room financing a specific technology. As exciting as that is, it is challenging work, but one that we embrace every single day here at LPO, and moving that bridge to bankability so that our country does well by innovating and reducing greenhouse gases in the mean, as part of a very happy outcome. So back to you. Did I answer?
Well, I think we're almost here at the end of our time, so I'll maybe just close out. I'd say that, look, in general, the insurance industry is at a very important place, I think, with the hurricanes in Puerto Rico and Florida. And when you think about, some of the other natural disasters in the West and drought conditions, I think that the insurance industry has been predicting a lot of these things for the last 15 years and asking, government to do more. We have finally done more with the Bipartisan Infrastructure Law and the Inflation Reduction Act. And now we've got to figure out how we practically get things done. So when you think about the role that that insurance plays in this whole thing, it's actually pretty important. So when you think about new policies that you're renewing, or existing policies, that you're renewing, you can imagine getting building owners to use all of the rebates and incentives that come in these programs to improve their building and make them more climate resilient will be critical. And hopefully you guys will reflect that in the insurance premiums you charge. But the same thing is true for, housing and whether the housing is in floodplains or not, and, how we help people, make better decisions as to where to invest, some of their, biggest asset and liability. But then I would say the last piece of it is that, it's the money that we're putting out the door needs to inspire $10 trillion of private sector investment. And a lot of that investment is going to come from the insurance industry and some of your colleagues in the institutional infrastructure industry. And I would say that outside of a few asset classes, let's call it solar, wind, hydro, geothermal, transmission lines, there are many sectors where the insurance industry, frankly, just doesn't even know what they would want. So if you would ask them, if I asked you, hey, what would you want in a perfect direct air capture project that you'd invest in, or CO2 pipeline, or nuclear project, right? Or hydrogen project, I'm not sure you know. And so that's something we can help with. There are actual projects that we know about that we could show you, right? Maybe anonymize it because of some of our confidentiality requirements, but we can show you a business model. And we could ask you, hey, what would your thoughts be? What would your due diligence questions be? What, protections would you want from the federal government, either through grants or loans from us or other things, to be able to get you more excited about investing in that asset class? And so I do think that making sure that we have a robust conversation, not only on the risk side, but also on the opportunity side, is going to be important, both for your businesses and for, our ability to, hit our goals in terms of reducing carbon emissions and, reducing the risk of severe weather. So with that, thank you so much for your time today. And thank you, Andrew, for joining me here on stage.
Yeah, thank you. Pleasure.
Take care.
Hello, I'm Connecticut State Senator Matt Lesser, co-chair of the Insurance and Real Estate Committee. Today, we're going to hear from a panel of experts about climate change initiatives on the state and federal legislative front. Here with me today is Katie Dykes, the Commissioner of Connecticut's Department of Energy and Environmental Protection, or DEEP. Katie previously served as chair of the Connecticut Public Utilities Regulatory Authority, PURA, from 2015 to 2018. And as Deputy Commissioner for Energy at Connecticut DEEP from 2012 to 2015. Katie?
Well, thank you so much, Senator Lesser. It's really great to be part of this exciting panel. And I want to thank you for all of your leadership that you've been providing in the legislature on our insurance regulation and ensuring that we have some nation-leading frameworks here in the state of Connecticut. I also want to thank Commissioner Andy Mais for his leadership in convening this summit. Commissioner Mais and I both serve on the Governor's Council on Climate Change, which Governor Lamont convened in 2019 and has been tasked with recommending strategies to reduce carbon emissions and also helping our state to adapt to the impacts of climate change. Here in the state, I know in part because of the leadership of legislators like yourself, Senator Lesser, we have new requirements for the incorporation of sea level rise in planning for keeping communities safe during major flood events, such as those that we have seen in Florida and Puerto Rico. And we also have invested with our flagship universities, like the University of Connecticut, in ensuring that we have research partnerships and policy supports for the state and for municipalities, so that we can have downscaled models of real actionable projections of sea level rise and other critical climate indicators to inform our regulatory frameworks and our planning. DEEP is really proud as well, my agency, that we are able to support communities with new types of funding to help them plan for investments in climate resilience. It's very opportune this moment that with so much federal funding becoming available. for communities to invest in climate resilience, that we have state bond funds that for the first time are available for communities to hire consultants and do community engagement to begin to envision the types of projects that they want to put forward to build a pipeline of resilience projects that can be competitive for federal funding. We know federal funding for climate resilience has grown by 400%, with more than $49 billion in funding now available from the Bipartisan Infrastructure Law and the Inflation Reduction Act. Those federal dollars have the potential to transform our communities, especially environmental justice and vulnerable communities. And we're really excited to be partnering with communities to help them build up, again, a pipeline of compelling projects to help secure those dollars and bring them to into our communities. We know that Connecticut has already been facing the impacts of climate change. We've certainly, over the 10 years that I've been working here at the state level, we've experienced lots of impacts in terms of heat waves, tropical storms, hurricanes, flash flood emergencies, as well as increased significant drought. These are all things that we talked about as projections and now are here as a reality. And so we are, as we're prioritizing investments in keeping our communities safe, we are also doing as much as we can to further reduce greenhouse gas emissions across the state to meet our target of a 45% reduction by 2030 and 80% by 2050. And we're joined by many states across the country as part of the U.S. Climate Alliance who are working towards those efforts. And it's really exciting to think about how the Department of Insurance and the insurance industry can play a role in facilitating both resilience and mitigation by helping to value common sense measures that will make that make buildings more resilient and that help to secure the funding that can ultimately also contribute to buildings being more efficient as well. So really excited to be part of this summit and happy to engage in the dialogue today. Thank you.
Thank you so much, Commissioner, and I would love to be part of that conversation going forward. But I had a question about the Governor's Council on Climate Change, which I know you chair and which includes the Department of Insurance and 10 other state agencies. Can you talk about that interagency conversation and how the department is leading in that conversation?
You bet. Well, we know that because climate is touching nearly every aspect of our lives and our economies, it's really important to have agencies working collaboratively together across the state to implement resilience and mitigation measures. I think this whole of government approach is something that Governor Lamont embraced when he established the Governor's Council on Climate Change and included both our Department of Public Health, Department of Transportation, our budget agency, the Office of Policy Management, and as well the Connecticut Green Bank, the Department of Insurance. All of these different agencies have an incredibly important role to play. And it's finding those, the Governor's Council has been really invaluable in bringing expertise from across state government to help inform 60 recommendations that we provided to Governor Lamont in early 2021 for coordinated efforts that could be taken across state government for mitigation and resilience. I'll note that the Department of Insurance has played a really important role on a working group that we established within the Governor's Council. It was specifically focused on how to bring the insurance industry to the table to help finance resilience and ensure that the risks of climate change are reflected in the insurance industry. The Department of Insurance was a co-chair of the council's working group on this topic, and it has certainly informed a lot of efforts, I'm sure, not just within insurance, but in my agency with respect to our work on building codes, and thinking about our collaborations with the Green Bank to think about how we can leverage financing tools that we've historically used for energy efficiency and emissions reductions to also support and value investments in measures that make buildings more resilient. So this is just one example of how we've the collaboration across agencies has enhanced the response that each of our agencies, I think, are contributing to addressing climate change.
Thank you, Commissioner. And as the Council has identified climate change hazards, what actions have the legislature taken to address those hazards? And where are we currently?
Well, it's, every session, I think we say, this is the most ambitious session and impactful session for addressing climate change. And I think just because the scale of the problem continues to accelerate, but the solutions are also proliferating, that we continue to see nation-leading legislation passing every year. I'll note it, in the 2022 legislative session in Connecticut, we were really excited to see the Governor Lamont's proposal for achieving a 100% zero carbon electric supply by 2040, advance to the governor's desk, as well as the Connecticut Clean Air Act, which is a really sweeping bill that will help to drive down emissions from the transportation sector, which is one of the largest source of greenhouse gas emissions and air emissions in our state. The legislature has also provided for funding for climate smart agriculture and forestry to help our working lands, our farms and forests become more resilient to the impacts of climate change, as well as to help working lands contribute to a net zero carbon budget. We know that when carbon is sequestered and stored in forests or forest products and soils, that can result in negative emissions that help to offset the emissions we cannot drive down to zero. And on the resilience front, it was great to see the legislature continuing a really innovative streak. First, 2 years ago, the legislature authorized the Connecticut Green Bank to expand its scope to focus not just on energy efficiency and renewables, but also resilience measures and other environmental objectives. And then in the 2022 session, a bill passed that expands the Property Assessed Clean Energy, or PACE, program that's backed by the Connecticut Green Bank to allow businesses to access the PACE program for low-cost financing for resilience measures, which is really, really exciting. So, some of these different, that last improvement, I think, is an example of the kinds of tools that the agent or entities like the Green Bank can bring to businesses, to residents, and to the economy as a whole. The demand for those types of tools, of course, will be driven by how the insurance industry is valuing risk and reflecting incentives that encourage property owners to invest in in resilience measures and mitigation measures. So, we're excited about this progress. There's certainly a lot more to do. I guess last one I would note is support for municipal funding sources for resilience. This is another really critical need. We were excited to see governor's bill pass that gives municipalities the option to raise revenues for financing resilience projects through establishing stormwater utilities and municipal flood prevention, climate resilience, and erosion control boards. In a home rule state, that's really, really important to ensure that our local governments have sufficient dollars for matching funds for some of that enormous amount of federal funding that's becoming available to support more resilient infrastructure.
Thank you so much for that. We are also joined, we're very lucky to again have California Insurance Commissioner Ricardo Lara on with us. Commissioner Lara has a long record as one of California's most effective environmental champions. He's passed laws that promote innovation and investment in clean air, embrace equity, protect waters from oil drilling, and keep California at the forefront of confronting global climate change. He wrote the nation's first climate change insurance law to protect Californians from climate-linked environmental disasters like wildfires, extreme heat waves, and sea level rise. And he's the co-chair of the Climate Risk and Resilience Executive Committee Task Force at the National Association of Insurance Commissioners. Hello, Commissioner Lara.
Good to see you again, Senator Lester. It's great to be here with you.
Commissioner Lara, I hear you've got some opening remarks.
Yeah, absolutely. I'm grateful to Commissioner Mais, my good friend, for the invitation to speak today and share my experience as a state insurance regulator. And I'm also pleased to be joined by my co-chair, Commissioner Altmaier from Florida, who's going through a lot, unfortunately. Again, I'm also delighted to be here with representatives from FEMA and the Connecticut Department of Energy and Environmental Protection. Insurance is really an evolving field because it's really centered around risk, which are consistently changing. And how we approach new public policies and insurance regulations really must evolve to meet that challenge, especially in the face of dynamic risks like climate change. And so for years, California and other like-minded states like Connecticut have warned repeatedly that we need to prepare for the impacts that climate change is having on risk and our ability, I should say, to prepare for it. Wildfires, flooding, heat waves really don't respect state borders, and we have to work together as insurance-based regulators of insurance to really tackle this risk that we keep seeing. And as many as insurance in the US is regulated at the state level, and insurance commissioners really set policies that apply to companies operating in our jurisdictions through the National Association of Insurance Commissioners, as you mentioned. And state insurance regulators really coordinate sharing knowledge and experiences from their efforts. This is why we're constantly in communication with our colleagues in Connecticut. This system has really an immense value because it allows individual states to act as test beds for new policies while providing for knowledge transfer to other states. And quickly in California, my department really has been working on prioritizing climate policies to ensure consumer protection and a reliable insurance market in the future. Changes to insurance laws can guard against disruptions to both consumers and insurers. In December 2019, implementing a moratorium law that I proudly authored while I was in the state Senate that protects wildfire survivors from preventing insurance companies from non-renewing policies for those living adjacent to a declared wildfire emergency for a total of 1 year. This law really recognizes it's absolutely critical to give consumers some breathing room after a wildfire disaster. Even if they don't lose their home, they might have lost a neighbor, a friend, a loved one. And so really this action allows insurance companies also a chance to assess, so they're not so quickly willing to drop their longtime customers. And to date, since 2019, I've protected more than 4 million residential policies from non-renewals by insurance companies. And so again, as regulators, our approach to insurance supervision needs to be comprehensive. I'm also proud that I've created a historic sustainable insurance roadmap, working with the United Nations on principles for sustainable insurance, which really outlines key actions that regulators and insurance companies need to take to protect consumers, to create a more sustainable insurance market in a time of intensified climate risk. This would be the first of its kind in the world. And through this roadmap, the department is providing a vision of how to approach innovative risk management and solutions that reduce climate risk and protect our natural infrastructure. And we are, again, the first regulator in the world to have this kind of guide. The roadmap really is centered around 4 foundational strategies. 1, strengthening transparency and financial oversight. 2, accelerate transition to more sustainable investment strategies. 3, really catalyze insurance product innovation to achieve climate goals. And really the last one, which is critical, is create resilient communities. These strategies provide new tools and policies for how insurance regulators really can approach the current and future climate risks. Again, changes to state laws can strengthen climate adaptation because insurance rules and incentives can transcend jurisdictional boundaries. Wildfires have always been a part of California's history, but in the last few years, we have strategically seen new records for loss of life, acres burned, and losses of homes and buildings. And with rising temperatures extended droughts throughout the western part of our country, and expanding development into wildland urban interface, wildfires are going to continue to increase, unfortunately. And so what I've observed in the last 3 years in California is communities really rolling up their sleeves and taking action to harden their homes and neighborhoods. But the risk can seem complex, and homeowners don't always know what to prioritize. That's why, again, we brought together all these California agencies that have experience in wildfire mitigation, really to come up with a list of home and community hardening measures for insurance. And this work was finalized in the past February when we launched our Safer from Wildfires framework, really providing the public with a consistent approach to reducing wildfire risk, with a list of effective actions that homeowners and businesses can take to really harden their home. And again, these are all critical measures that are important, that we work with the legislature, work with our fellow commissioners to really look at what other states are doing. I would just say in sum, Mother Nature is our best advocate we have on climate change. As you look at the wildfires, heat waves, flooding events, you cannot deny the reality of what we're facing or the need for immediate action. Further reducing risk and closing protection gaps are going to be vital for strengthening our nation's climate resilience today and tomorrow. Thank you again for allowing me to share a few thoughts, and look forward to answering your questions.
Thank you so much, Commissioner, and it's great to have you on again. It's great to see you again. I just wanted to follow up because you talked about wildfires, but I'm curious, having the country just go through a large, almost nationwide bout of heat waves, what do you see as the role for insurance with responding to that kind of hazard?
Absolutely. Of course, of climate intensified perils, extreme heat events are the most deadly extreme weather in the US. Just a few weeks ago in the Western United States suffered one of the hottest heat waves in history. The blistering event set records from Washington State to Southern California and all the way up to the High Plains. Sacramento was hotter than Phoenix, and Ukiah, which is a small town in the Redwoods area, was even hotter than that. And we were all very concerned about blackouts due to the strains on the energy grid, as well as fire from combined heat and lack of water. So currently the cost of heat waves are largely uninsured, and extreme heat impacts fall heavily on our most vulnerable and marginalized communities. Last year, we started taking some important steps, I should say, toward future solutions. In July of 2021, after 2 years of work, my department released the first ever climate insurance report, including a recommendation from our climate insurance working group. The working group included public policy experts, environmental advocates, and insurance experts. On their key recommendations was the need to be able to rank heat waves. So last November at COP26, I announced I was sponsoring new legislation to create a heat ranking system for California. That legislation was signed into law, and now my office is already looking to the next step, of which is to develop new innovative insurance mechanisms to protect communities from extreme heat. And so it's going to allow us to better communicate the risks associated with extreme heat. We can't just treat it as another weather story in the news. We have to rank, collect the data, and along with that, we're going to be doing some research in my Department of Insurance to look at the hidden insurance costs, both uninsured and insured cost to extreme heat. So stay tuned. We'll definitely share what we've learned through our data collection and through how we communicate risk better for our most vulnerable communities around extreme heat in California.
Well, we will anxiously await that, Commissioner. And do you have any other approaches that you think might be of interest to those of us who are in other jurisdictions?
I think, again, further collaborating, Commissioner Mais and I are lockstep in all this work that we're doing. Collaboration helps policymakers learn from each other. Each of these areas are innovative in resilience, and insurance creates insurance really creates an example that other states and other jurisdictions can draw from. I would just say, a recent major example of this has been the adoption of new TCFD-aligned climate risk disclosure survey. And up until 2020, only 6 states implemented our annual climate risk survey for insurance companies. But the number has grown. In 2022, I could say a bipartisan coalition of 15 states now will be administering the survey in their jurisdictions. Climate issues can be contentious and polarizing, as we know, but we are seeing people engage, I would say, from both sides of the aisle when it comes to climate risk and disclosure. Our international engagement is another cornerstone for innovation. California is a founding member of the Sustainable Insurance Forum, a group of more than 20 insurance regulators, including France, Australia, Japan. And this group is chaired by the insurance regulator of the Bank of England. And so, again, we need to further capitalize on coalition, building our networks. And to say now that the TCFD disclosure survey is going to represent 80% of the insurance market in the country is amazing. I would have never thought we would have been here, but really working on creating those coalitions. And of course, Commissioner Mais has been lockstep with me in growing this coalition of folks. And this is a major accomplishment for us. TCFD aligned disclosure with additional insurance specific questions is what we need. And hopefully now getting the US in par with what is happening in Europe. So it's a very, very big win for us.
Well, thank you, Commissioner, and it's great to get that update, and we look forward to continuing our 2 states' continued partnership on that. And thank you again for being with us. Next up, we have Whitney Welch, who is a grants management specialist with FEMA Region 1 within the Mitigation Division, Hazard Mitigation Assistance HMA branch, where she is the regional point for the Flood Mitigation Assistance Program and supports the Pre-Disaster Mitigation Program and Building Resilient Infrastructure and Communities, or BRIC program. Whitney, great to see you. And had a few questions. Can you provide a brief overview of the FEMA mitigation programs that promote the inclusion of climate change and resiliency activities?
Thank you, Senator. Thank you for inviting me to participate on this panel discussion alongside these amazing partners. Currently, FEMA actually has 5 mitigation grant programs that support the inclusion of climate change and resiliency activities. These include both that you already mentioned, the Building Resilient Infrastructure and Communities, or BRIC, Flood Mitigation Assistance, or FMA program, the Hazard Mitigation Grant Program, HMGP Post-Fire, and Public Assistance Mitigation Funding. The Building Resilient Infrastructure and Communities program is funded by a 6% set aside of the assistance FEMA provides following a presidential disaster declaration. And funding is broken into 2 buckets. So there's a state, tribal set aside, and national competition. For fiscal year 2022, our program priorities include incentivizing natural hazard risk reduction activities that mitigate risk to public infrastructure and disadvantaged communities, incorporating nature-based solutions, enhancing climate resilience and adaptation, and increasing funding to applicants that facilitate the adoption and enforcement of the latest published editions of building codes. The FMA program is a nationally competitive flood hazard only mitigation grant that funds both mitigation projects and mitigation plans with funds annually appropriated by Congress. Now, historically, the FMA program funding source was a fee charged on all national flood insurance program policies. However, for fiscal year 2022, awards will be funded in whole or in part with funds appropriated by the Infrastructure Investment and Jobs Act. Priorities of this program include capability and capacity building activities, which are your project scoping, partnerships, planning, localized flood risk reduction projects, and individual flood mitigation projects, all of which allow for and promote the inclusion of climate change and resiliency activities within their designs. The primary purpose of the FMA program is to reduce or eliminate the risk of repetitive flood damage to buildings insured by the NFIP. And eligible applicants for both non-disaster programs include states, tribes, and territories, while eligible sub-applicants include state agencies, tribes, and local communities. FEMA's Hazard Mitigation Grant Program provides funding following a presidentially declared disaster with the goal of funding projects that allow communities to rebuild in a way that reduces or mitigates future disaster losses. And HMGP post-fire intends to mitigate post-wildfire secondary hazards, such as floods, erosions, and mud flows in areas in or near burned lands following a fire management assistance grant declaration. Lastly, public assistance mitigation is funded under the FEMA PA program. PA mitigation funding provides support for mitigation measures in conjunction with the repair of the disaster damaged facilities. So it is limited to declared counties and eligible damaged facilities, but public assistance mitigation funding is typically applied on the portions of the facility that were damaged by the disaster, but can mitigate the entire facility on a case-by-case basis. So PA mitigation project designs can also incorporate climate change impacts and other future conditions. And eligible applicants for the disaster programs include states, tribes, and territories, while eligible sub-applicants include state agencies, tribes, local communities, and certain private nonprofits. And for more information on any of these programs, we really highly recommend reaching out to the State Hazard Mitigation Officer, whose contact information you can actually find right on FEMA.gov.
Thank you. And can you talk a little bit more about how the passing of the Infrastructure Investment and Jobs Act impacted the FEMA hazard mitigation programs?
Absolutely. So the IIJA, or bill, provided FEMA an additional $6.8 billion to continue to address climate change through mitigation projects by appropriating $1 billion in funding for BRIC and $3.5 billion for FMA over a 5-year period, which has begun with fiscal year 2022. So what does this look like? Well, the recently released fiscal year 2022 BRIC Notice of Funding Opportunity has $2.295 billion available in funding. This is more than double the amount that was available in fiscal year 21. And the fiscal year 2022 FMA NOFO has $800 million in available funding, which is more than 5 times the amount that was available under this program in fiscal year 2021. As both these programs have historically seen total annual sub-applications exceed available funding, we will likely see an increase in the number of projects awarded, which is wonderful.
That is really good news. And you noted that both the BRIC and FMA programs include competitive funding. Can you just discuss how the national competitions incentivize climate change and resiliency activities?
Absolutely. So the BRIC program projects considered under the national competition undergo a national technical review and qualitative review. The technical evaluation criteria offer incentives for elements valued by FEMA, informed by the current FEMA strategic plan. And these include if the sub-application is an infrastructure project, if they're incorporating nature-based solutions into the design, if the applicant implemented mandatory adoption of current building codes, if the sub-applicant has a building code effectiveness grading schedule rating of 1 to 5, and if the sub-applicant has a CDC social vulnerability index of 0.6 to 0.79 or is designated an economically disadvantaged rural community. The qualitative evaluation criteria are narrative submissions, which allow sub-applicants the flexibility to fully explain the strengths of the proposed project. And scoring criteria includes the incorporation of risk reduction, resilience effectiveness, climate change and future conditions, implementation measures, population impacted, community engagement, and other outreach activities and leveraging partners. Beyond priorities and scoring, these programs actually allow for the inclusion of climate change considerations, such as incorporating sea level rise into designs for coastal projects, utilizing modeled damages for increased precipitation events, and expanding and updating ecosystem benefits within the FEMA benefit cost analysis tool.
Thank you so much.
Thank you.
Lastly, we are joined by Florida Insurance Commissioner David Altmaier. David was appointed as the Florida Insurance Commissioner in 2016 by the Financial Services Commission. He leads the Office of Insurance Regulation, or OIR, and his oversight over one of the largest insurance markets in the world. Under Altmaier's leadership, OIR has worked to cultivate a market in Florida in which insurance products are reliable, available, and affordable. And he is taking a lead in responding to the effects of Hurricane Ian.
Well, good day. Thank you for having me here, Commissioner Mais. It's always a great opportunity to share some of the insights from Florida. I certainly appreciated being a part of this conference last year and looking forward to being a part of it again this year. So just want to say thanks to the Connecticut Department for the invitation. I'm David Altmaier. I'm currently serving as the Insurance Commissioner for the state of Florida, the Sunshine State of Florida, as we like to call it. And I thought what I would just do is share a few insights of some of the things that we've got going on down here, much of which we've been working on all year, a lot of which has been re-emphasized in its level of importance after the landfall of Hurricane Ian from a couple weeks ago. Hard to believe it's already been almost a couple of weeks. Let me kind of start first with our property insurance markets. You've likely seen a lot of media attention on our property insurance market, especially in light of Hurricane Ian. But our property insurance market has been challenged for a number of years now. We've got significant challenges with respect to the affordability of insurance products. We have significant challenges with the availability of insurance products in the residential property insurance market. A lot of this is driven by a variety of factors, one of which is we've unfortunately had some elevated catastrophe activity, with Hurricanes Irma and Michael being especially devastating to our property insurance market. Hurricane Ian will add to that disruption, I'm sure. But those elevated catastrophe losses have hardened the global reinsurance market, which our domestic industry is very reliant on. So that's introduced challenges. But we have also had just some historic challenges with excessive litigation. And all of that is exacerbated by the heightened catastrophe activity that we've had. So our property insurance market has not been profitable. In fact, they've lost a couple of billions of dollars on the underwriting side of the house over the past couple of years. So we're seeing a lot of insurance companies that are withdrawing from our market. So far this year, we've already had 6 property insurance companies become insolvent. And we've seen the companies that are remaining in our market express a need for some serious rate increases. We've been approving rate increases anywhere between 30 and 60% this year. So obviously not a good situation for consumers. The good news is that through a series of legislative reforms, including most recently during our special legislative session back in May, the state of Florida has taken some pretty considerable steps to address a lot of these challenges. We've been focused on the excessive litigation that we have in our market. Just to put that into context, in 2021, Florida had approximately 8% of all homeowners insurance claims in the country, but Florida also had approximately 76% of all of the suits filed against homeowners insurance companies in the country. So obviously significantly out of proportion there. And so that has been the focus of our attention legislatively over the past several years. In 2019, we passed House Bill 7065. In 2021, we passed Senate Bill 76. And most recently, as I mentioned in our special session in May, we passed Senate Bill 2D. All of those things, as I mentioned, look at the way that attorney fees are paid in the state of Florida, which we think is one of the driving factors for the litigation challenges that we're having. And it's the first time, I think, in our state's history that we have actually addressed the issue of attorney fees, which I think is going to make a meaningful difference going forward. Already in 2022, we've seen almost a 25% decrease in year-over-year litigation against insurance companies, which I think is very positive. I think there's still more work to be done. And so I'm looking forward to next year leaning into some of the legislative momentum that we've had to continue to take some steps to shore this up. Also, it's going to take some time, even though we've seen some good initial results from this legislation. It's going to take some time for that to start making its way to the balance sheets of insurance companies, into the pocketbooks of consumers. But we're going to continue to stay very diligent as we continue to work on that. One of the things that Senate Bill 2D also reauthorized, it was a program that was already existing and it was just simply refunded, is the My Florida Safe Home project. This is going to provide some funding for consumers to focus on resiliency efforts for their homes. And so there's now going to be some funding. If you qualify, it'll be administered by the Department of Financial Services here, where consumers can actually get some funding to help mitigate their homes against future catastrophe losses. And between that and a bill championed by CFO Petronas that allows some tax incentives for such mitigation, I think consumers now are going to have some incentives to look at ways that they can shore up their homes and that we can shore up our communities to be more resilient in the face of natural catastrophes. I'd be remiss if I didn't take a few moments and talk a little bit about our experience so far with Hurricane Ian. As I mentioned, it made landfall in around Fort Myers, Florida, which is in the southwestern part of the state, a few hours south of Tampa, as a Category 4 hurricane, a very strong Category 4 hurricane, and brought with it just a historic level of storm surge. And it came ashore on September the 28th. And since then, I'm sure you've seen the media photographs of the area that was impacted. It's just been devastating for the community, not only from an insurance standpoint, but obviously just from a disruption in everyone's way of life down there. So the entire state government has been in and around Fort Myers and Port Charlotte and other impacted areas as we have looked for ways to expeditiously put everything back together down there. I've personally been down in the area. Most of my staff have been down in the area, and we have a considerable number of staff that are still down there assisting consumers with insurance information and just about everything else that folks need help with. The office is collecting claims information on a daily basis. As of yesterday, we were around $4.2 billion in expected losses just from claims that have been filed so far. So we expect that number to get significantly bigger. A lot of the modeling firms are estimating anywhere between 40 and $60 billion in total losses. Some are even higher than that. And so this will be one of the costliest natural disasters in all of the country. One of the challenges that we anticipate twofold. First of all, as a Cat 4 storm with such significant storm surge, there's going to be a lot of wind versus water discussions when it comes to claim time, and sorting all of that out when there's not much left of a property to adjust is going to be challenging, both for our direct writers as well as for the NFIP and the private flood insurance companies that we have writing down here. So we're going to be working through those issues. I'm sure we've got some experience with that after Hurricane Irma, and obviously some other states that were impacted by storms like Hurricane Katrina have gone through that as well. The other thing that we're going to be working through is, unfortunately, you'll read, as we do after most significant flooding events around the country, a very significant number of people who either did not purchase flood insurance or did not purchase enough flood insurance. And so we will be helping those folks as much as we can, but continuing to reiterate to everybody in Florida that even if you don't think you are at risk for flooding, you should still explore with your insurance agent buying flood insurance. And we like to joke here, it's not much of a joke, but we like to say that if you pull out your driver's license and it was issued by the state of Florida, then you need flood insurance. And so we're going to continue to double down on that messaging and hope that we can continue our efforts in closing that protection gap. Long term, we expect that this will be a significant event for the global reinsurance market as well. And so we expect that market conditions in the reinsurance community will continue to harden, which will make the impacts of this storm a little bit more long term in nature as our direct writers go back out into the reinsurance renewal cycle. And so we've got a long road ahead of us with respect to Hurricane Ian recovery, but we've got all hands on deck all across state government, and we're looking to get into the communities and get that put back together as quickly as we possibly can.
Hello, this is Congresswoman Rosa DeLauro, representing Connecticut's 3rd Congressional District. Thank you for inviting me to join you for this year's Connecticut Conference on Climate Change and Insurance Summit. I want to thank Commissioner Andrew Mais and all the members of Connecticut's Department of Insurance for hosting the 2nd Annual Climate Change Summit and for bringing us all together today to discuss and explore how climate change affects our communities and businesses. Climate change is one of the defining crises of our time, and it is happening even more quickly than many feared. No country or corner of the globe is immune from its devastating consequences. Rising temperatures are fueling environmental degradation, natural disasters, weather extremes, food and water insecurity, economic disruption and conflict. Sea levels are rising, the Arctic is melting, coral reefs are dying, oceans are acidifying, and forests are burning. Inaction is not an option. The longer we wait, the higher the cost. In South Central Connecticut, we've experienced 2 tornadoes in the past 7 years, which was unheard of in the past. We have also witnessed destructive hurricanes take lives and cause billions of dollars in damage. In fact, Connecticut has experienced 15 extreme weather events, including the devastating hurricanes Sandy and Ida over the last decade, which have cost Connecticut families more than $5 billion in damages. The American people expect Congress to take bold action to confront this climate crisis. So as the cost of climate change continues, reaching record highs, it is time to act. That is why I am pleased that the bipartisan infrastructure law will strengthen our nation's resilience to extreme weather and to climate change, clean up toxic pollution, expand access to clean drinking water, remediate legacy pollution, deliver electric school buses to support clean air, and so much more. This funding will help communities increase resilience to heat waves, drought, wildfires, and hurricanes by preparing before disaster strikes. I'm also proud that we passed and President Biden signed into law the Inflation Reduction Act, which was not only a historic step to reduce the deficit and fight inflation, but was the largest investment to combat the climate crisis in history. It provides an enormous opportunity to confront the climate crisis by making transformative investments in clean energy and the communities most impacted by this crisis. It takes the necessary steps to address the climate crisis by reducing carbon emissions by roughly 40% by 2030. This historic package provides an enormous opportunity to confront the climate crisis by making transformative investments in clean energy and the communities most impacted by the crisis. There is still work to be done, but we are making progress. So thank you again for inviting me to speak today and all of your efforts to mitigate the impact of climate change, as well as assisting our communities in addressing challenges associated with climate, risk, and sustainability. I'm thrilled to be your partner in these fights, and I look forward to continuing working with you to find the solutions to this crisis.
Welcome to the Connecticut Conference on Climate Change and Insurance. This is a panel on resiliency in action, specifically on financing. Thank you to Commissioner Mais and George Bradner for putting this panel and this event together. My name is Brian Garcia. I'm President and CEO of the Connecticut Green Bank. We've assembled an excellent panel today comprised of professionals with varying expertise as it applies to the topic of climate financing, and specifically resilience. I'm going to ask each of them to introduce themselves to give you a better sense of that expertise by delving into a specific question. But before we jump in, let me set some context. The Climate Policy Initiative has always been my go-to when it comes to climate finance capital flows. Their Global Landscape of Climate Finance 2021 report looks at climate finance trends from the perspectives of sources of capital, public versus private sources, the instruments for that capital, albeit they grants, debt, equity, etc. Uses of capital, are those uses for the mitigation of greenhouse gas emissions or adaptation and resilience, or both? And what sectors is that investment going towards? Energy, water, transportation, land use, and others. On average, about $632 billion of climate finance was invested each year in 2019 and 2020. About a 10% growth from the prior period, which doesn't yet show COVID-19's impact on climate finance, which, as you could imagine, is worrisome from a climate perspective. If we delve deeper into the sources of climate finance, we can see that the public sources represent 51%, while private sources represent 49%. Public sources increased by 7% from the prior period of 2017 and 2018, while private sources increased by 13%. And you can see the various public sources of climate finance from state-owned financial institutions to national development financial institutions. And you can also see the various private sources of climate finance from households and individuals to corporations. In terms of the instruments for that capital, we see that debt dominates at 60% of the capital flows, equity at about 35%, and grants at about 5%. Climate finance from grants increased by 33%, debt by 1%, and equity by 23% from one period to the next. So in general, what we observe is that there's about $630 billion of public and private climate finance a year in 2020. Again, this is pre-pandemic, about a 10% growth from the prior period, of which it is evenly split between the two sources, public and private sources of capital. Debt dominates the capital stack at 60%, as we'd expect, but is stagnant, with both grants and equity seeing significant growth. Given the topic of our panel, however, with its focus on resiliency, let's look at the uses of capital. A majority of climate finance went to mitigation at $571 billion, or 90%, while over $60 billion went to investments that include adaptation. Adaptation finance has always trailed mitigation significantly, but what is good here is to see the trend of increasing climate finance in adaptation, an increase annually of over 50%. Now, having said that, the public sector continues to provide almost all of adaptation finance, while the private sector mostly provides mitigation finance. From the perspective of a green bank, we always look at this problem of increasing investment in solutions to confront climate change by leveraging public sources to mobilize and attract multiples of private investment. So now let's come back down to earth and delve deeper with our panelists. Our panelists are going to bring perspectives from the public and private sources of resilience finance and the role of philanthropy in enabling more private investment in resilience. All right, so with that as some context, I'm going to ask each of our panelists now to introduce themselves. And we are going to start with Pete Caminiti. It would be great, Pete, if you could introduce yourself to our audience from the perspective of your expertise, as well as the role Zurich North America is playing to address the risks posed by climate change.
Sure. Thanks, Brian. So my name is Pete Caminiti. I'm our Chief Underwriting Officer and Property Technical Director for Zurich North America. Zurich's a global property and casualty insurance company with substantial operations here in North America. But actually, I think most relevant for this conversation is I'm actually our executive sponsor for North America Climate Resilience Program. And so when we at Zurich, when we think about climate resiliency and climate risk resiliency, we really think about three key audiences. We think about our customers, of course. We think about our employees, and then we think about the communities that we live and work in. And so when we think about from a customer perspective, there's products and services that we've developed and have made available to help our customers manage their climate risk, manage through transition risk. When it comes to our employees, we've got benefits and services that we offer to our employees. But when it came to our communities, that was the piece that we really wanted to figure out a way to have impact, because again, the communities are the foundation for everything that we do. So to try to find a way of addressing our communities, we knew it was something we couldn't do by ourselves. So we looked for a partner, and that's where we found the Resilient Cities Network. So Zurich, through its foundation, the Zurich Foundation, in partnership with the Resilient Cities Network, have come up with a way to identify communities that have both a need and are actually ready and able to deploy certain resources. And it really gave us an opportunity to partner and create this connection between financing, our technical capabilities, but then with an organization that has the know-how and the network to begin working in local communities. So the community front has been a really interesting piece for us because that is something that we could not do by ourselves.
Great, thank you for that introduction, and I'm looking forward to delving further into that with Stuart when he comes up. But let's just dive a little bit further into the insurance industry a bit. So for insurance industry novices such as myself, so can you describe the regulatory structure for insurance? For example, who regulates the market when it comes to climate change? What are the roles of the federal government versus state governments when it comes to managing climate change risks?
Sure. Yeah, so the insurance regulatory market is a state and territory, 50 state and territory regulatory market. So insurance companies work with the departments of insurance in each state and territory. Really it's through product regulation, which is the way that insurance companies work most closely with those individual regulators. And so while that certainly creates a challenge for organizations that operate in multiple states, because of course we have multiple insurance departments we have to work with, the benefit of a system like that is you have local regulation for what really matters the most in those local communities. And so that allows state regulators to really focus on the needs of their local community. And so where we see benefit of that is, think about the United States, a huge geographic spread. The risk that you might have present in Connecticut is going to be different than the risk in Florida. It's going to be different than the risk in California. And that allows each state regulator to really focus on the needs of their constituents. The federal government, on the other hand, there's the National Association of Insurance Commissioners. So that brings together the network of each of the states and territories together, where they can come together and work on some common problems together, come up with some common solutions, set some common standards. So it's beneficial. So you get that balance of kind of a federal umbrella, but with very local regulation. The role of the federal government in this, I think, is when we start to get into things like various types of programs that the federal government may run, or when it comes into actually funding, certain types of initiatives. The role of the state regulation is really critical to making sure that some of the things that we're going to need to do in the future to address climate risk is going to have to be local. And it'll be really important for state legislatures, state regulators, the communities, as well as the private sector, to really come up with some local solutions. And I think that's where the regulatory structure that we have today will be really beneficial.
That's great. I think that notion of local knows best, is a very much fits in the federalist kind of principles. It's only us on the ground in our communities that knows what we need because of the impacts that we're feeling. So it does feel like the role of state regulators in this context versus having somebody in Washington, D.C. making decisions is a good place to be in the context of this. All right, so next up is Taryn Akiyama. So Taryn, I'm going to ask you to introduce yourself to our audience from the perspective, again, of your area of expertise, and specifically some of the things that Climate Finance Advisors, a member of WSP, has been working on to address resilience. I know you're working on this. Perhaps there are some lessons from abroad that may be applicable here in the United States based on your firm's work. So Taryn.
Sure. Thanks so much, Brian. I'm delighted to be speaking with you all today on the really pressing and urgent topic of climate adaptation and resilience investment. So I'm a project consultant at Climate Finance Advisors, or CFA, and we work at the intersection of climate and investment. And earlier this year, we were acquired by WSP, a global leader in sustainability, engineering, and design. And what this means in practice is that we can serve as a one-stop shop for climate adaptation and resilience investment, as well as infrastructure. So at CFA specifically, we support our clients on the funding side of adaptation resilience. So for example, we provided snapshots of 26 federal resilience funding programs geared at U.S. Climate Alliance states, and that was published in USCA's Governor's Climate Resilience Playbook last year. Another publication that we contributed to was the American Society of Adaptation Professionals and Climate Resilient Consulting's Ready to Fund Resilience Toolkit, which was released earlier this year. So that's a little bit on how we support our clients on the funding side, but we also support our clients on the financing side of adaptation resilience. One of our main projects last year centered on what can we learn from EU member states and how can we apply that to the context of US states. So while adaptation resilience, as we know, are driven a lot by local context, there's still a lot that we can learn from one another and in order to scale action on climate change. So through this project, we facilitated cooperation between EU member states and US state governments on various topics, including how can we leverage insurance incentives, such as reduced insurance premiums, to incentivize property owners to make their properties more resilient to climate hazards? Or how can we help to establish a fund to support local governments and community stakeholders in resiliency planning, investment needs and prioritization, and project financing through capital grants, equity grants, or loans? And then another project centered on how to determine actionable options and the best methods for revenue generation for climate resilience, including own source revenue and blended finance. So our team has been working with the state of Connecticut and many different agencies for over a year, and we're really excited to be working with them and tackle the thorny challenge of how to both fund and finance adaptation resilience.
Excellent. Thank you for that introduction there, Taryn. And I can say, as one of the U.S. Climate Alliance states, as Connecticut is, I think we're one of 25 or 26 Climate Alliance states around the country. We represent, I think, about 40% of 60% of the population or GDP and 40% of the emissions. So you can have economic development at the same time, keeping our emissions down, and just really appreciate all the support that you've provided the USCA states over time. And then you also, I think, subtly gave our audience here a distinction between funding and financing. And I'll point it out, maybe you'll go into this deeper, but I think what you're saying is funding is a source of money coming in that doesn't have to be paid back. In financing, maybe funding that's coming in, but you do have to pay it back. So you're using them in a distinct way. Is that just a quick? Yeah. Okay. Cool.
Yeah, absolutely.
Cool. So we'll go into that further as we get into the funding questions. So thank you for that introduction there, Taryn. The Climate Policy Initiative research shows several things when it comes to the role of public sources of climate finance as it applies to the area of resilience. First, when it comes to resilience, the public sector dominates. And second, that there's a trend towards increasing resilience finance capital flows. So tell us a little bit about the landscape for federal funding opportunities for resilience from the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, or other things that you see coming out of the federal government.
So I would say that the CPI research on global finance trends is very similar to US climate finance trends. There hasn't been, to my knowledge, a study of that same Sankey diagram done at the US level, because it's very complex and very difficult to gather all that data. But at a high level, would agree that a lot of the investment at this point on adaptation resilience has come from government, whether that's federal, state, and local levels. While it's been a little bit slow to progress on this issue, more recently, especially in the last year, this has been a really exciting time for adaptation resilience in the US. The recently passed Infrastructure Investment and Jobs Act, IIJA, also known as the Bipartisan Infrastructure Law or Bill, as well as the Inflation Reduction Act or IRA. So lots of alphabet soup for you. Because the IRA is still relatively new and centered on climate mitigation and clean energy, for today, I'm just going to do a deeper dive into IIJA, which is a little bit more centered on climate resilience and adaptation. So as you can see from my slide, the IIJA encompasses many different types of topics. Overall, it encompasses approximately $841 billion to be allocated over the next 5 years. And right now, the slide shows in terms of the funding in millions. So overall, IIJA encompasses 378 new and existing programs. And you can see here it's broken down in different ways. Resilience on the far left here is the one with the most programs at 99. And you can see kind of the smattering of others. Just for illustrative purposes, it's not perfectly like this. I did the shades of salmon is a little bit more related to resilience and adaptation. The shades of blue are a little bit more related to mitigation, and gray is more other or miscellaneous. So you can see here from the left, resilience and adaptation with the 99 new programs is an exciting time because there's lots of money and lots of programs being developed around this topic. However, when you look a little bit deeper into how that translates to funding, you can see how things slightly change. So when you look at it in terms of funding, resilience ends up being about 37 billion or 38 billion rounded up, and it makes a smaller fraction of the funds going into IIJA overall. And a lot of that is actually going towards roads, bridges, and major projects. And you can see water also is a big part. So they're definitely resilience related, but in terms of the resilience specific category as defined by the federal government, that equates to about 38. And if we look into just a spotlight on a couple, I won't spend too much time on these, but I've just highlighted a few that fall under that resilience category that make up the greatest funding. So there's the Federal Highway Administration's PROTECT program, which is on formula and competitive grants related to transportation infrastructure. There's a FEMA's Flood Mitigation Assistance Grants, which focuses on flood risk, and particularly with regard to National Flood Insurance Program. There's the Army Corps of Engineers Coastal Storm Risk Management, Hurricane and Storm Damage Reduction Projects, which focuses on different infrastructure projects. And then moving forward a little bit more, there's also a similar project on inland flood risk management projects. And FEMA has a Building Resilient Infrastructure in Communities program, which relates to capability and capacity building activities for hazard mitigation. And then finally, there's the Safeguarding Tomorrow Through Ongoing Risk Mitigation or STORM Act, which I won't speak too much right now because I know that'll be covered later.
Well, that was great. Thank you for that overview. And yeah, I was going to say that we're going to come back to that STORM Act later. We're going to advise the White House in terms of how to think about that. What's really interesting in terms of your presentation are a couple things. One is I hadn't thought about the IIJA from the perspective of mitigation versus resilience. And clearly it feels like the IIJA programmatically is more of a resilience build out as opposed to mitigation of greenhouse gas emissions. The second lesson I think I take there is that as we build our roads, bridges, and major projects, we really need to make sure that those are going to be resilient to the impacts of climate change, since it's a large part of the investment from the federal government in that infrastructure. So thank you for that introduction there, Taryn. So now let's turn to Kimberly Cornett, and I'm going to let you introduce yourself, Kimberly, and talk about what the Robert Woods Johnson Foundation is doing to mobilize private investment in resilience in the United States. And really, what makes a $15 billion foundation interested in the insurance sector?
So I'm so happy to be here. Thanks for inviting me. I learned something from Taryn already, so it's great to be with such a distinguished group of guests. So I'm Kimberly Cornett. I lead the impact investing program at the Robert Wood Johnson Foundation. We are a large private foundation based in Princeton, New Jersey, exclusively focused on health equity. So we come to climate resilience and climate change actually through the prism of health. And I think there is a growing awareness that in many ways, climate change is the visible, we see the visible impacts of that, but really the downstream effects really show up in doctors' offices and emergency rooms further down the line as people show up experiencing asthma from mold, extreme fatigue from heat, loss of property, which in some cases results in people not being able to have power to support their medical equipment. And so we're really looking at trying to mitigate the effects of climate change using our investment tools of debt, equity, and guarantees as a way to really ensure that particularly the most vulnerable communities can also remain healthy. And we all know that climate change is here to stay with us. And more people are having that personal experience where their health is really being impacted after a climate resulting event. So what we're doing is really looking at who are the major actors, in addition to the federal government, which Taryn outlined so nicely, who have a business interest that is aligned with our goals around health. And when we look around the capital markets, insurers really come to mind. Insurers, we believe, benefit when people and entire households and communities are stronger, more resilient, when their homes are more resilient. And so we've been looking to create partnerships with different elements of the insurance sector to try to bring more capital to communities to make those resilient investments as a way of really ultimately helping people to be healthier.
So that's great. So tell us more about this work. I think Pete mentioned the NAIC, but tell us a little bit more about this work that you're doing funding insurance commissioners' offices.
Sure. So one of the great things about being an investor inside of philanthropy is that we have a range of tools that we can bring to bear against a problem. And one of those is grants, and then we have a suite of investment tools. But we often know that it takes some pre-development money, if you will, to get a conversation going. And so as we looked at how could we bring more capital from the insurance sector, more of the best capital from the insurance sector to community development, we really realized it was going to require several interventions. And one was building relationships with insurance commissioners who had aligned interests, who also were seeing the impacts of climate change and the resulting impacts in people's health within their communities and wanted to do something about it. So we're very pleased that we have established grant-making relationships with 6 state insurance commissioner offices and their aligned nonprofit partners to begin kind of getting the flywheel moving about what are the responses that an insurance commissioner could consider, whether that be policy change, whether that be new partnerships, whether that be a capital market solution. So we're really trying to build a cohort across the country of insurance commissioners who are really thinking quite boldly about what the role of their office is in being able to mobilize the financial and the policy resources that are going to be needed in order to get individuals, families, and communities to the place where they are most resilient to the impending effects of climate change.
So I wanted to say on behalf of Connecticut, thank you for your support. Because Connecticut is one of those states, and I'm sure if Commissioner Mais were here, what he would say is that in the context of the project that you're supporting here in Connecticut, climate smart technologies really matter, and they matter for those who reside in affordable housing, but specifically those in affordable housing that may have pre-existing medical conditions. So, in the event the hurricane comes through and knocks out the power, what happens to those that rely on that power system? So we're really going to dive into that a bit, try to understand what the needs are, and then ultimately try to figure out how we can identify investment opportunities that are going to both reduce greenhouse gas emissions, probably reduce some energy burden too, reduce those energy costs, but also understand how those measures can improve their resilience. So, for example, whether it is battery storage when the grid is down, that's one thing, whether it's a hot day and making sure that these residents have a cool place to go, all those sorts of things. So just want to say thank you for that support. And again, as we look into that, our goal is going to be, okay, let's figure out some investments. Let's do some investments with the goal of attracting the insurance and the healthcare industry into this space because it is really a public health matter, to your point. So,
and what you will learn in Connecticut, we hope is going to inform many states. I'm sure many of us heard over the summer, Arizona experiencing, over 90 days this calendar year of temperatures over 100. And one public official was on the radio saying that grid failure in that state is something that they have to plan for. That's a Katrina-like event that for people, as you say, Brian, who are dependent on medical technologies at home could be, life-threatening. So really, I thank you guys because I hope that you're going to uncover, some solutions that work in Connecticut that other states could consider replicating as well.
Great. Well, thank you for that introduction. All right. And lastly, we have, as part of our panel here today, Stuart Sarkozy-Bonisi. And Stuart, why don't you take a moment to introduce yourself to our audience and your expertise, and talk about the role of the Resilient Cities Network that we heard from Pete, and what role it's playing in terms of encouraging a more private investment in climate finance.
Sure. Thanks, Brian. And great to have this moment to discuss all this with the panelists and just sort of listening to everybody. It's always hard to go last, but sometimes when you are last, you sort of hear the flow in a really natural way. And hopefully what I say will sort of add to that and get into our discussion. So again, my name is Stuart Sarkozy-Bonisi. I'm the Global Director for Policy and Investments at Resilient Cities Network. And in that portfolio, part of what's relevant today is I'm in charge of the launch and management of the Resilient Community Impact Funds, the RCI funds, and a coalition that's called the Resilience 21 Coalition, a policy effort that's made up of resilience practitioners all around the United States and beyond, actually. That came out of the late 2020 wish to influence the federal government and other layers of the government based on the experience that we had with the cities themselves. So I've been involved with Resilient Cities Network and what was 100 Resilient Cities since its beginning in 2013. And in this process, we have continued to sort of really bear down on what we mean by resilience. And in some ways, Pete mentioning how we're partnering gets at the heart of that definition, because we don't see it as just the shocks of natural disasters. We do not see it as just the stresses that are already there. It's the combination. And our definition of resilience means that we're looking at not just survival, not just adaptation, but thriving. And that's the part that's most difficult because we often don't plan to do the pre-recovery work. We're often in recovery a lot. And that goes with health, that goes with infrastructure, that goes with a lot of this. So for us, it's a very holistic, equitable view of what we mean by resilience. And that means where the shocks and stresses collide, we want to be there to be doing the work that builds the resilience out ahead of time. And as Pete said, we have partnered with the Zurich Foundation and Zurich North America on the new program. But one interesting piece about the program is that Resilience for Communities program lifts up the ways that we work, because it's programmatic, it's implementation, it's policy, and it's also funding. And it's the funding and finance, and the definition was nicely made already by Taryn, but the idea being that we have to be able to step in to do some of the project preparation funding and some of the grant making that happens ahead of time, so that the financing pieces that really put those projects on the ground make the difference in those communities from that holistic nature. Not just building a wall, building a bridge, building a road, all those things are important. But when you sort of think about the matrix of holistic resilience, we want to be in there with the cities. And sometimes it's smaller cities and sometimes it's larger cities, because they all have a role in that solution set.
So it sounds like the importance of that pre-development funding to pre-recovery, I like that term, is really, really important. There kind of is a strong nexus there in terms of some of that early stage investment to help people thrive. I like how you're thinking about resilience in that connotation, because that's really what it's all about. We want to thrive and not just recover. So in preparation for this panel, I know as we were chatting, you were excited by a number of federal policies that passed or may have bipartisan support and like in the process. So in addition to Taryn's overview, what else is out there that excites you, and why? What should our audience be looking for?
Yeah, I think there's a couple of them. And the one that we've been working on the most through Resilient Cities Network and the Resilience 21 Coalition is the National Climate Adaptation and Resilience Strategy Bill, the NCARS bill. And part of the reason is that it's the piece of the work for resilience building at the federal level that puts the framing together, because it offers up a chief resilience officer for the federal government. It offers up the interconnection between the agencies, because having been in the federal government and having worked on the Hurricane Sandy task force, it's the integration of silos that we all know are there that often prevents us from getting to the resilience that we really want. And so the measures, including some of the equity measurement pieces, so measurement and measures that are in the NCARS bill, really start to get us to that kind of common framing and common language. Because in a lot of places, whether it's the city, state, or the federal government, we're often still working with different definitions and silos that do not blend one agency or cabinet member or whatever it might be together with the other one. That's one that we're excited about. Another one is what's called CEDARS. It's the Community Development Resilience Zones Act, where we would look at this cross-section of where, again, it's the kind of places where you've got Cancer Alley and impacts to low to moderate income communities, plus dangers from natural disasters and economic issues that have been there based on redlining that's decades and decades and decades old. And then the hurricane comes, right? So we're trying to get in front of this by also supporting places that already feel like the shocks and stresses are pretty heavy, pretty burdensome. And this relates to what Kimberly said. And we talked about this at the NAIC conference in April in Kansas City. Where you have those health issues, they are only going to be worse, and COVID sort of proved that. So the cascading effects of the kinds of things that we saw during COVID, and when a big shock comes like a hurricane, should point to those kinds of things that we feel are coming through these pieces of legislation. There are others as well. And again, it's the policy and how we spend the money and the money itself in combination with other sectors kind of funding coming together. And that sort of intersection is what we're really excited about and looking forward to.
All right, so let's shift gears here a bit from the introductions to some open questions. And let's start off with the government response. So, beyond what we expect to see with respect to climate finance impacts, from COVID in 2020 and 2021, the data that we looked at was 2018 and 2019. 2022 is clearly the year that climate change demonstrated its wrath around the world, including the recent hurricanes that we saw in Florida. So what do you all expect to see more at the local, state, and national level in terms of responding to climate change from a resiliency perspective? For example, you had noted there, Stuart, are we going to start seeing chief resiliency officers in our communities and corporations? And why don't we start with Taryn?
I think from my perspective, resilience is such a inclusive issue. It really brings together all kinds of people. It really brings it home of why climate change, how it affects them personally. I think we can reach so much more people with resilience and adaptation because it has to do with their specific communities and how they're being hurt and what hazards they're facing and, what are the solutions for that area. And so I'm really hopeful that this is an issue that won't get too politicized going forward. And it's one that we can find more agreement on and accelerate funding in this regard. But in particular, I think resilient infrastructure, I think, is going to be really, really important in the next decade, because a lot of the infrastructure that's going to be built out through these IIJA and IRA funding over the next 5 years, they're going to have really long lifespans. And so it's really, really critical that we make sure that the infrastructure that's being built now is going to be able to withstand the hazards that we'll face 50 years from now, maybe even 100 years from now, and really ensuring that we are building them with the latest climate science and climate models in mind, while also recognizing that we might need to adapt as we go and course correct along the way.
So modernizing the infrastructure that we're doing now with all this investment also means making it more resilient to the impacts of climate. Very cool. I think maybe that's something the bipartisan, because it's the bill, maybe that's why we've seen so much investment in resilience coming through the IIJA as opposed to the IRA. So thank you for that. Why don't we go to Pete?
Yeah, Brian, when I think about resilience, unfortunately, I find that resilience tends to be the thing that we turn to once we've learned that rebuild and recovery is no longer effectively working for us. So there's unfortunately some hard lessons that have to be learned before we really start to turn to resilience and realize that we're going to have to do something differently. And as you pointed out, I mean, 2022 or even the past couple of years have really played out for us, that there have been a number of situations where I think people are starting to realize that resiliency will be the way that we're going to need to deal with some of this. And we've got some really good examples of where we're starting to see that have some meaningful impact. So, I think the bright side of this is, with disaster, with catastrophe, comes this kind of rebirth of, how to best address these problems going forward. And so I do hope from here we can use some of what we've experienced over the last couple of years to really jumpstart some of the response and addressing the need for resiliency.
So thinking about it before and maybe investing in it before it happens, it feels very pre-covery to me. Stuart, why don't we go to you?
Yeah, thanks. It does, and yet it's really hard. Humans are not great at paying for things that are not supposed to happen, or lessening those things that are not supposed to happen, from wills to healthcare to insurance sometimes, right? So I think what we're starting to see, though, is the response that you need to do in many cases, even if the natural disaster isn't so natural, can be lessened if you're prepared in various ways. And that's just in the basic kind of rapid response and recovery kinds of activities. But I think what I'm hopeful for is that there is, as with the NCARS bill, a bipartisan nature around resilience building, because it means security, it means safety, it means risk reduction. And in that sense, that's where we're seeing our partners like Zurich and other insurance companies and banking and other elements of society kind of coming together to say, you're right, look at the cascading effects that we saw. We can prevent some of the cascading effects by being smarter on the front end. So I'm hopeful because the money is in there. My broken record piece is that how we spend it will be even more important than what's in there or where we're spending it in some cases. So how we spend it from an equitable standpoint is going to be really important. And I'm hoping we're ahead of that curve a little bit this time.
So I suspect what we'll start to see from the Climate Policy Initiative is maybe in its 2023, 2024 reports, a continued increase not only in global investment in climate finance, mitigation and adaptation and resilience, but we'll start to see resilience start to tick up proportionately and be more in the overall context. And beyond recovery, to your point, this is about thriving. So the full, let's get out of the always thinking about its disaster. I think that's a real important lesson for all of us to take. All right, Kimberly.
So I would echo what Stuart says, in that it is hard for us as humans, but particularly for government, to pay for things that are not going to deliver a benefit till many years down the road. And that's particularly difficult for elected leaders, where those benefits are going to accrue probably outside of the time of their tenure. Many of us will remember from the recovery from the Great Recession that there was a scanning of the universe for shovel-ready projects. And the truth is that in the most vulnerable communities, those projects probably are not shovel-ready, but they are shovel-worthy. And so I think what we have been focused on is what is the early funding and financing that needs to go to communities first to get them ready. And that is often a combination of at-risk capital and technical assistance. So as just one example, we provided a $5 million loan to an organization called Communities Unlimited. They're based in the Deep South. They are pairing pre-development financing for water utilities who intend to make application to the state revolving funds with technical assistance in an effort to get those communities to the starting line. And I think that is, we're at a historic moment right now with so much investment coming from the federal government. But I think it is beholden on all of us, certainly in philanthropy, in kind of the community development finance sector, to prepare those communities to get to the starting line. This is a very complicated undertaking for a community that is, low on capital and might be low on capacity too, but they too deserve the opportunity to have those investments in their community. So I would just say that, I think one of the policy aspirations that we're hoping for is a greater awareness into future funding, that pre-development really is a key part of the recipe of success in having many different communities benefit from these historic level of investments.
And it sounds like from that the focus on vulnerable communities, those who have contributed the least to the problem but bear a majority of the impact is really important. And in Connecticut, as we went through Tropical Storm Isaias a couple of years ago, our Public Utilities Regulatory Authority really prioritized vulnerable communities. Our legislature passed an act and really wants to focus on enabling more resilience with targets towards vulnerable communities to enable that investment to lift in their communities. So great, thank you for grounding us in that important equity Justice 40 initiative focus. All right, so we've been having this conversation around investment. So let's move to private investment. And what is it really going to take to unlock private investment in climate finance and resilience? Given the wildfires, the droughts, the floods, and more happening around the world, will private investment naturally increase as a result, or is there a role for government to encourage that investment? And we're going to start off with Pete. I want to start off with you because we really want to understand the drivers to insurance companies in terms of their potential investment in resilience. As a preventative measure before a climate-related natural disaster occurs.
Yeah, I'll start with your question around just the private investment. Will it naturally occur? I go back to a comment I made earlier. I think it will when it becomes a matter of necessity, right? And that's usually when you see people start to make those investments, is when they've come to that realization that the repair, the rebuild is just not sustainable. And so you do start to see some of that private investment start to occur. And from an insurance perspective, when we think about private investment from an insurance standpoint, or the role of government here, and one of the challenges for us as an insurer, and so we're primarily a large commercial insurer across the United States with mid-sized customers up to large multinationals. For us, I mean, we certainly see opportunities and always encourage that investment from our customer in improving their risk landscape. But when it comes to climate, there's a particular challenge with transition risk. And I think there's a place for public-private partnership to really help manage through transition risk. So as an example, there may be a particular hazard, a particular risk that a customer or a community is vulnerable to. We can certainly, from an insurance perspective, see the path to where that would become a better insured risk for us, a more resilient customer. But the challenge is getting them from where they're at today to that place would require us as an insurance company to assume more risk than we would be today to be able to lean in and try to work in that area. So we need to figure out from an insurance industry perspective, and I think this is where we could do it with some help from public-private partnerships, is how can we lean into those areas where there is transition risk, figure out new ways to mitigate that transition risk, make it manageable so that we can make the necessary investments. And once those investments pay out, we would certainly have a much more resilient customer, much more resilient community, and ultimately a more insurable risk for us. So it's really about figuring out how to get from where we're at today to beyond that transition risk, and that's the challenge that we're faced with every day right now.
So let's keep going. So Stuart, any follow on to Pete's response there? What sort of perhaps technical and financial assistance, before versus after, does the Resilient Community Impact Fund provide? Funding is always important, as we know, but you also provide, based on what you were talking about before, technical assistance too, right? So could you talk about both the financial and the technical assistance of the program?
Yeah, I mean, my shorthand for this is kind of tools, pools, and partners. And the reason I say it that way is that we know we have things we want to do to kind of like push the measurement and push the assessment and push the impact and the tracking. But we also know that we need the funding in there, and that's funding and finance. We decided to set up the Resilient Community Impact Funds to be on the front end with those tools so that we're pushing further down and bringing our cities together with these public-private partnerships. Because I agree with Pete. I mean, I think there's a necessity that will come. Our role is to really sit with the cities and start to say, how do we bring everybody together to do this work? And sometimes that will take us being the one to kind of trigger the incentivized funding and doing a bunch of technical assistance ahead of time and the project preparation. It could actually mean the policy and the legislation, everything from zoning to sort of like business taxes and laws has to get adjusted. We're about to launch the first cohort of what we're calling the Global Risk and Resilience Fellowship with secondees from insurance companies in cities around the world. And if you think about how they would interact and kind of propose ways to work together, at the same time, we just announced this investment protocol for coastal communities, coastal cities. And in that investment protocol, we have kind of what we call the blue paper that says, we need the technical, we need the financial, we need the capacity building, and we need the funding and finance to kind of work in a kind of flow in a system. And so we sit kind of in the middle with that. We're responsible to our cities. We work with people like Zurich who have the same responsibility from the insurance side. So we want to kind of, it's a bit of a clash sometimes, not with Zurich. It's been kind of amazing, actually. But there are companies who kind of look at us like, well, what do you mean you want us to step into this space? And do something different with the government? Doesn't the government just do this already? So I think what we'll see is not just necessity, but also all of us that are sitting around the table right now kind of pushing a little bit further, because Kimberly described some of that even in her own work, right? It starts to, you get in there ahead of time with people and kind of lift them up and move it together at the same time.
I was going to say that's a natural transition to Kimberly, because it really feels like the question here that you posed is what's the role that philanthropy can play in this part here. And Kimberly, I'd be interested in knowing if there is an investment opportunity with the foundation, and who are you hoping to partner with as you think about these investments?
So I like to say that the place that we like to be the most is where the perception of risk is higher than actual risk, or where the benefits, those long-term benefits that we talked about, need to season or kind of mature in order for an investor to be comfortable. Those are the kinds of risks that are well suited for the foundation and the social impact goals that we're trying to achieve. So I would kind of go back to an example of a transaction that we did a number of years ago, where the federal government had a new credit program. But if you're familiar with the feds, they like all losses to net to zero, no losses to the taxpayer, which is a fine goal. But that often requires, finding different pots of credit enhancement. And we believed that in this particular situation, the Treasury Department was overestimating the risk of one particular asset class that we believed had a performance track record, but they just needed to see it and experience it. So the foundation provided a guarantee for 3 years in order to let a portfolio of mortgages season and to demonstrate their financeability and on-time performance payment. And then after that, everybody agreed that, in fact, that asset class had proven its worthiness, and we were able to back the credit enhancement down. That's really what we like to do for the government, for private investors, for intermediaries like green banks and CDFIs, is we want to help get the appropriate entity in the transaction, and then to be able to slowly kind of take off the training wheels as the assets perform.
I was going to say that feels very green bankish, in that you're de-risking things so that certain sectors of the private markets can come in to provide their capital. And, in the green bank sector, I feel like we've done similar things to bring the banking industry in. And whether that's motivated by the Community Reinvestment Act, whether it's motivated by risk return expectations, and we're helping them get their return, you're trying to bring that big, large source of private capital in to solve the problem. That's great. All right, so now what's it going to take? I'm going to show you an image. We talked about a little bit about this before in terms of global climate finance. And I'm going to ask several of you, what's it going to take to increase public and private investment to confront climate change? Earlier, I was talking about trends in climate finance globally. And this is the blue area here on this curve. You remember the $630 billion roughly in 2018 and 2019 going into climate finance, 50-50 of that coming from public and private sources, roughly, 60% debt, 35% equity, 5% grants, and 90% of it being targeted to mitigation versus 10%, but on adaptation, but the adaptation was rising. So it's kind of fitting with a lot of what you all are saying. But we're currently nowhere where we need to be in terms of annual climate finance being, $4.35 trillion a year to meet our climate objectives. So why don't we start with Taryn, just in terms of what do you think it's going to take to get there?
Sure. I think the panelists have spoken to a lot of this already, but just really engaging, public-private partnerships and working together on these issues. I think it's become very clear that the federal funding alone is not going to be able to solve the problem. I think NOAA tracks climate events that have cost more than $1 billion, and this just increasingly grows and grows each year. And so, while it is amazing that the federal government has increased funding in this area, I really think that it's going to require action from the private sector and public-private partnerships to really move the needle. And one example of this that I just want to highlight, given that this is a climate change and insurance summit, is the Strengthen Alabama Homes program. This is through the Alabama Department of Insurance. And what's interesting about this program is it focuses on the climate hazards or wind specifically, and the impact of wind on single family homes. And what's interesting about this program is that it's not funded by federal grants nor the state's budget, but it's actually funded by the insurance industry. They provide funding that allows for Alabama homeowners to enact different measures on their properties up to $10,000. And this reduces the amount that they have to pay on their wind premium. So depending on the level of mitigation, there's 3 different standards they use, from fortified program through IBHS. There's fortified roof, fortified silver, and fortified gold. And depending on what level they achieve and how ambitious they are in terms of addressing a wind mitigation, they get discounts between 20 to 60% on the wind portion of their insurance premium. So this is just one example of ways that the insurance industry could be more of an active player in promoting resilience, and particularly in the residential property area, which needs more attention. So there's a study from the University of Alabama that found that the homes that met the fortified standards sold for nearly 7% more than non-fortified homes. So this ends up being not only beneficial on the insurance industry side because they have less to pay out in claims, but it's also helpful for the homeowner because then they can sell their homes for more money.
And it sounds like with that example, Taryn, that we're coming back to the P-federalist argument. So I assume the commissioners in Alabama felt that addressing wind damage was really important, given the impacts that they're facing. and decided to work with the insurance industry to figure out this kind of solution to address the problem. So really kind of good to see that state regulator to the insurance industry delivering the products, you know, to a certain standard. That's a great example. All right, so let's keep going here. So this is an opportunity for all of you to advise the White House. So we'll just kind of start there. In January of 2021, as all of you know, the Safeguarding Tomorrow Through Ongoing Risk Mitigation, or STORM Act, was passed in Congress. And this is a $500 million program to be offered through FEMA to provide capitalization grants to states, tribes, and other government entities to establish revolving loan funds while providing hazard mitigation assistance for local governments to reduce risks from natural hazards and disasters. All right, so now with John Podesta taking the reins from Gina McCarthy at the White House, and all of you know Gina McCarthy is our hero here in Connecticut. He's going to be overseeing the climate change investments from the U.S. government perspective. So if you had the opportunity to advise him on how to spend that $500 million revolving loan fund, what would you say? And why don't we start with Stuart?
I would love to be able to make these kinds of recommendations, of course, directly to John Podesta. And I think one of the ways that money itself gets used most wisely is to be sure that we're looking across the programs and sort of thinking about the ways that things like other legislation and support helps get that money moving in the right way. That revolving loan fund program reminds me of early work that I did with CDFIs and impact investors, especially in Native communities. And so I think that akin to that, we have to make sure that that money flows in such a manner that's much more equitable than some programs start out as, and sort of begin at a point there where it's equitable resilience that's being funded at the very front of the system, if you will. And in doing so, it looks across to the BRIC program that's also at FEMA, but looks across at HUD CDBG, especially the disaster response, the DR money, and starts to say, here's how we're going to use this loan fund. And here's how we're going to build out what is essentially like a resilient CDFI model with a revolving loan fund kind of behind it, and be sure that what we're saying is both definitionally the same and operates together and not in these silos. Because anyone who's worked in the federal government or gotten federal grants or both, you know, the gray hairs come when X program or X agency ministry won't fund one that's kind of, you're trying to cross the streams, right, and really align the funding. It's in some cases prohibited, or it just doesn't work into one particular program. So that'd be the first thing I would say to John Podesta as he looks at that money and the other funds that are flowing, because there's not a common framework yet out of the White House for resilience. It's one reason the NCARS Act is so important, is like, how do you get the common framework and spend that money in the most responsible way?
That's great. So it feels like across government and equitable resilience. Very, 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 very good. Why don't we go to Pete?
Yeah, on this one, I would say I'm going to resist the temptation to pick the favorite peril or hazard that I might personally have, because I think one of the things that's been really eye-opening in participating in this discussion has just been there are so many different ways to get after the problem, and no one of us has the exact answer. So I think when I think about this question and the discussion that we've had today, I think number one, the $500 million is certainly not sufficient to solve the problem. But what we heard a lot of today was, how can you use funding as a catalyst to get things going? And so I would think about, how could you use these funds in a way that could actually start propagating something that might take on a life of its own. And then the other thing, going back to a comment I made at the beginning, was I'd have to think locally. Maybe set some success criteria on how these funds would be used, but then really figure out how to create that catalyst at a local level. I think that, if you were to try to pick a particular area to focus nationally, I don't think you'd get the full impact that you could get from this funding than if you found ways to really deploy it at a local level.
That's great. So not sufficient. It would be a catalyst at the local level. And, just looking at it, revolving loan funds, what it brings to my mind in terms of thinking about big programs are the state revolving funds that the EPA administers for clean water and drinking water. This may be an opportunity to demonstrate that catalytic funding at a local level may lead to more investment in the federal government later on using that as a model. So great. That's great guidance there. Taryn.
Sure, I don't have too much to add based on what my panelists said, but I would say that one, I'd love to echo what Stuart and Kimbler were talking about in terms of addressing vulnerable communities that are at greatest risk and really need the most support. And then maybe just one other thing I would add is ensuring that there's funding to support capacity building. What we hear time and time again from a lot of the state and local partners is, their staff is overstretched, or they don't have the expertise in-house, or they need more funding for tools and resources. So making sure that the money is not just for physical infrastructure or projects, but making sure that we're also putting people at the forefront of that and really building up for the future.
Excellent. Well, thank you all. That was great guidance. And thank you for the question. All right. So as we wrap up here, I wanted to give several of you an opportunity for some parting thoughts. So if there were, one thing that you'd like to leave our audience with in terms of the future of climate finance for resilience, what would it be? And why don't we start with Pete?
So I think if I could leave the audience with just one thing, because I think a lot of us are sitting here saying, how can I have an impact? Where can I be most effective? What role can I play? The thing I think I'd want to leave everyone with is find a partner. This is something in what you heard from the panel today. This is something that no one entity or individual is going to be able to tackle by themselves. So even if you don't know where to begin, start by looking for a partner, figure out what it is that you could bring to the table. It might be technical support, it might be financing, but find somebody who can complement you or several organizations that could complement you. Because I think you'll find that once you get started, the ball will really start to get rolling and you'll be able to have impact much broader than you would have thought you could have on your own.
Excellent. Taryn.
Sure. Building upon what Peter said, I think my takeaway would be, we don't need to reinvent the wheel each time. We can learn from one another. And I would encourage everyone listening to look not just for examples domestically, but also look internationally, because there might be some interesting, innovative things going on in the space that we can learn from and grow from and scale action more quickly.
Fantastic. I wanted to say, think globally, act locally on that one. Stuart.
Yeah, it's tough to not echo the partnership piece that Pete brought up, because it's what brought us together with Zurich and found those ways of working together. I think one of the things that I would add that came out of that partnership that I was going to mention previously was the way that it empowers local people and does the right kind of storytelling is also something that is going to be important as we move forward. And that partnership brought a kind of community training, community capacity building, and awareness and storytelling that I think is really important. We know how important it is to have the data and the science and the facts, but being able to explain that and build capacity and do the right kinds of storytelling, not just when a disaster comes, but when we're trying to prepare and we're kind of bringing everybody together. I think that ends up being more fruitful if we really find strong ways to do that are very visual and bring local partners in.
All right, so thank you, panelists. Really, on behalf of Commissioner Mais, George Bradner, and the Connecticut Insurance team, the Connecticut Conference on Climate Change and Insurance, thank you all for this panel on resilience in action financing. I think you gave us a lot of things to chew on. And we've got a lot of work ahead of us to ensure that the public and private sectors are mobilizing more investment in resilience. And to the extent we're doing that, we're going to thrive. Thank you, Stuart, for that. And it's on all of us to figure that out, because climate change is here today. It's impacting all of us, and enabling more investment to flow to help families and businesses weather those disasters or things that are coming, or prepare for and just enable us to live better lives, I think is the lesson. So if you're interested, there are a few resources that our panelists are going to provide to you. Feel free when you go and listen to this on YouTube, in the description, take a look. There'll be a few links that might be useful to each of you as you delve further into climate finance and specifically financing resilience. So thank you, everyone.
Hi, I'm Richard Blumenthal, your United States Senator. Very proud to be part of this summit organized by the Insurance Department. And I want to especially thank Commissioner Andrew Mais for his leadership and really all of the attendees and participants in this conference. We know that climate change is creating a new normal in this country that threatens the planet, as well as very immediately our economy and our health. The intensity and frequency of droughts and floods, cold snaps and heat waves, rising sea levels, the superstorms and powerful hurricanes that have become the new normal for coastal states like Connecticut or Florida are not only alarming, but they are heartbreaking. They affect people's everyday lives, as we know. They uproot and upend the lives of everyday Americans who may lack insurance for their homes or for other property or for their health. And the role of an insurance department in protecting people is more and more important. And so I want to thank everybody in the insurance department for your great work. In Congress, we've passed the Inflation Reduction Act, which for the first time, the very first time in United States history, invests in a significant and serious way in fighting climate change with $369 billion. It will go for tax credits and grants to people who make their homes more resilient or install energy-efficient appliances, for people who buy new electric vehicles or used ones and are eligible for the tax credits, for people who want to increase the efficiency of their heating and cooling systems in their homes. Only a few of the ways that the Inflation Reduction Act and this commitment to fighting climate change will make a difference in people's lives. Now, it's far from the end of what we need to do. It's a beginning. But we need to be all hands on deck, whole of government, committed to do whatever it takes to turn history against climate change, to convince other countries to join us, to lead by example in the United States. And your summit, no doubt, will help to do so. I know that people in Connecticut, the vast majority of people, are on our side. We need to make sure that their will and their feeling are represented in the actions that government takes. There is an old saying that there's no limit to the amount of good you can do if you don't care who gets the credit for it. Everybody working on this problem has a role and responsibility, and thank you for all your great work.
Okay, hello everyone. Thanks for being with us today. I'm Carolyn Kuski. I'm the Associate Vice President for Economics and Policy at Environmental Defense Fund and a longtime researcher of disaster and risk transfer topics. So I am always happy to be talking about these themes, and even more so with such an amazing group of panelists with me today. And I'll get around to introducing them in just a minute. But first, I want to tell you what we're going to be talking about. So in this session, we're focused on how risk transfer can contribute to creating more resilient households, more resilient communities, and also to improving equity in the outcomes we see from disasters. everyone listening understands the essential role of insurance is, of course, recovery. And we have a growing body of research that households that have insurance, for example, are more likely to rebuild. They have stronger and faster recoveries than those without insurance. And that's because other sources of funding for recovery we know can be insufficient, inaccessible, or just too delayed. And so as more members of a community are insured, we also see spillover effects and improved economic outcomes for the community as a whole, because economic activity gets reestablished faster as more people have the resources they need to get back on their feet. That all said, we are now seeing disaster insurance markets that are under stress. We're seeing a growing disaster insurance gap and ongoing and serious inequities in recovery, with some groups locked out of access to affordable and appropriate risk transfer products. So we also have a ways to go. On the other hand, insurance can also be used to help promote risk reduction. There's long been hope it could provide financial incentives to insureds to invest in lowering their risk. And there are emerging concepts about things like increasing payouts at the time of rebuilding to fund the incorporation of resilience measures, or new models that could use payouts for preparedness in order to help actually lower total losses. But a lot of these are still theoretical ideas or not in widespread use. So I think it's fair to say that we're not yet fully harnessing the potential of insurance to improve resilience. But this is an exciting time because there's lots of innovation happening in this space. And we're seeing a lot of emerging pilots and concepts that we're going to talk about today that I think really have the potential to move the needle on these issues. So I hope everyone enjoys this panel. I think it's very timely. We're also going to spend some time talking about what's needed to take the kind of emerging ideas and pilots we're seeing and scale them up and replicate them and expand them. And growing innovations around resilience is going to require lots of things like new and strengthened partnerships. We're going to talk about partnerships today, continued creativity in developing new approaches that can really center the needs of people and communities, and a concerted effort to remove barriers and obstacles. So that's me teeing up our conversation and why I'm so excited to be talking with everyone on this panel today. So let me introduce them to you. I'm going to start with Jake Clark. He's the managing director of the North America Public Sector team at Guy Carpenter, the reinsurance arm of Marsh & McLennan. Jake has over 30 years of market experience. He's advised clients on risk and supported their risk management strategies. And Marsh & McLennan is committed to building stronger connections between the public and private sector in order to manage the challenges that businesses and communities are facing from systemic risks like climate. We're going to talk about a lot of those exciting partnerships today. Let me turn on now to Theodora Macris. She's a senior policy and research associate at the Center for New York City Neighborhoods. She convenes the Coalition for Affordable Homes, which is a group of housing counselors and legal service providers throughout New York City that works to strengthen homeownership affordability and preservation statewide. Jackie Higgins at Swiss Re leads a team that designs, originates, and executes innovative risk management and transfer solutions with public entities throughout North America. Prior to that, Jackie was the head of global partnerships at the International Finance Corporation at the World Bank. And Andy Reid leads ISI's efforts to develop actionable natural disaster satellite data to public sector organizations. And before being at ISI, Andy was the vice president of public sector practice at Guy Carpenter. And before that, he was at FEMA, where he was the executive officer for the Federal Insurance and Mitigation Administration and an advisor to the Deputy Associate Administrator for Insurance and Mitigation. FEMA has very long titles, as part of the FEMA Resilience Leadership Team. So I am so thrilled to have these people with us today. We've actually all been working together on a project in New York City that I think is one of these unique partnerships, and we'll discuss some of that and also have this broader conversation. So let's start by each one of you telling us a little bit about how your particular organization is thinking about resilience. Jackie, do you want to kick us off on that?
Sure, happy to, and thanks for having me today. I think we're fortunate that we are an example of the public-private nonprofit partnership because we all are working together. So I'm looking forward to the conversation. So Swiss Re's stated mission is to make the world more resilient. And we do this by focusing on mitigating climate risks and advancing the energy transition, building societal resilience, and driving affordable insurance and digital solutions to advance access to insurance. Providing financial resilience against natural catastrophes is Swiss Re's core business, where the Nat Cat reinsurance makes up more than 20% of our property and casualty reinsurance business. And as as we all know, natural catastrophes are occurring with frequency, intensity, and severity, causing a distressing loss of lives and considerable economic costs around the world. And both industrialized and developing countries are affected. But as you articulated, Carolyn, surprisingly, both are materially uninsured. So, we estimate that about 65% of economic losses are caused by natural catastrophes over the past decade were uninsured, which leaves this financing gap to be borne largely by the public sector, which creates long-term fiscal instability at a time when we all know that government budgets are fully strained. So Swiss Re, about 10 years ago, was one of the first insurance reinsurance companies to create this dedicated team to working with governments at all levels to improve resilience and transfer risk. And as you articulated, I'm here today presenting the global team with a focus on North America. So thank you for having me.
Thanks so much for being here. Theodora, over to you.
Sure, thanks. Thank you for having me. So the center believes in resiliency as making housing and communities more broadly equitable for everyone, both in terms of homeownership attainability and household safety. And our programs and our mission are really rooted in creating pathways to healthy, sustainable, affordable homeownership opportunities for New York's working families. Resiliency to us means that communities of color have access to fair lending, that seniors have the resources they need to age in place, and that young New Yorkers see homeownership as something attainable. And now with the emergence of more severe climate events, it really comes down to making our older housing stock more physically resilient to climate change, both in terms of flooding and extreme heat, and ensuring that all New Yorkers have access to disaster preparedness.
Thanks, Theodora. Jake?
Thanks, Carolyn. And again, I appreciate the opportunity to be here with everyone today. Right, so at Marsh McLennan, right, 60% of our global business, which spans 130 countries, is focused in on risk and insurance. And right, that at its core is all about expanding resilience. When you marry that with the other 40% of our business that focuses in on consulting, we look to link those things up so that we can help provide our clients a roadmap to how do they achieve greater resilience, because I think everyone recognizes there are many issues at play, and sometimes those issues can go beyond just the risk transfer side of the equation. Given the nature of our business, we help clients think through and manage challenges that they're grappling with, issues related to people, health, physical risk, as well as systemic risks. And that features heavily in the services and the value propositions that we build. At our core, we believe it's really important that public and private sector work more closely together to handle some of the challenges that are coming at us today. Climate risk isn't the only area where we think this needs to occur, but it certainly features heavily in the dialogue that's occurring right now across the landscape. So we're looking for new ways to engage so that as a society, we can better manage risk, whether that be associated with weather or climate change or man-made risks, such as cyber and terrorism, just to mention a few. So really looking forward to this conversation today and focusing in on some practical ways in which we can start to achieve some of that.
Great, thanks, Jake. Andy, your turn.
Thanks, Carolyn. And thanks for the opportunity. So ICEYE is a satellite company, and we own and operate the largest constellation of synthetic aperture radar satellites in the world. And we've deployed that constellation of satellites to monitor natural catastrophes. We're now focused on building a global monitoring capability and analysis capability to bring solutions from ground, airborne, and spaceborne assets to governments in the insurance market to enable resilience. So this means we're able to deliver a global capability that will be consistent and can help insurers and governments address areas of resilience, including protection gaps and other things of that nature. So we're excited to be working with many governments around the world on this issue to deliver near real-time intelligence so they can better respond and allocate resources, and similarly be working with the insurance market also.
Great. Thanks all of you for providing that helpful introduction to where you are and what your organizations are doing. Let's now get into a little bit more specifics and details. Theodora, let's start with you. As you noted, your organization has seen households respond to disasters. Can you tell us a little bit about what you've learned about what the kind of needs are of different households and communities for improving their resilience in New York City?
Sure. So for those who may not know, the center has been a leader in storm recovery for homeowners since Hurricane Sandy hit New York City in October of 2012. Since then, we launched floodhelpnewyork.org in partnership with several city and state agencies to provide homeowners with resources they need to check their flood risk and flood mitigation options and to learn about flood insurance. And what we've seen since then is that homeowners and small property owners face increased flood risk and rising flood insurance costs. And many, unfortunately, are still recovering from Hurricane Sandy and now, of course, after Hurricane Ida. And they're in need of home repairs and renovation services to prevent future flood damage. It's taught us that housing counseling and wraparound services for homeowners is crucial to ensure that relief efforts are successful. And beyond that, when disaster hits, we've learned that families need emergency, no strings attached funding deployed very quickly so that they could use those funds however they need to support themselves and their families.
Thanks, Theodora. I think it's really exciting to see organizations like yours helping draw the connections from what the kind of real household needs are to what some of the financial solutions might look like. So talking about financial solutions, let's switch over, Jackie. I know Swiss Re supported resilience through many different insurance programs at different scales. So I just want to ask you to pick one or two that you think have been maybe most exciting or impactful that you'd like to share with us.
Sure, absolutely. And I do think it's interesting to have Theodora kind of the juxtaposition of her being kind of close to the end beneficiary. And I think the way that we see us is us supporting our public sector clients, right? And those tend to be governments at all levels. So it's a little bit higher up, but I think that that's what we're trying to do here, which is draw how does the whole supply chain kind of work together to provide support. So I think for us, the most impactful insurance programs are really ones where we're responding to the needs of our public sector clients. And I think that, for us, I just would like to mention, and maybe one where we've actually seen the demonstrated payout of one of these programs, which can demonstrate kind of how we're supporting resilience, because it's one thing for us to be kind of having created these programs, but you really want to see, you're not asking for a natural catastrophe, but you want to see how these programs really work in real time. And I think it's important to pick examples that demonstrate how the products really work and help people on the ground, rather than us talk about all the ones that we have existing out there. But, fortunately, we haven't had a natural catastrophe to test the product itself. So one, I can just speak of one, and for the sake of time, is we designed an earthquake parametric for the state of Utah. And for the state of Utah, they really wanted to use that to support kind of their traditional earthquake insurance, as well as to kind of cover some other expenses that they had in the event of a disaster. And it was tested on March 18th, 2020, when the Salt Lake City area was hit by a 5.7 magnitude earthquake, which was the strongest earthquake that the state had seen in nearly 30 years. And the parametric worked as structured, and there was a partial payout within 30 days, enabling the state to get back on their feet more quickly. And I think that this demonstrates the value of this particular product, which is a parametric insurance product, which is really enabling the public sector clients to recover more quickly. And it provides the needed flexibility that they can use those funds as needed once the event occurs.
Thanks, Jackie. That's a great example to actually, like you said, it was tested and kind of learn from. And I think important to highlight how we need all these solutions at all these different scales. So I appreciate those comments as well. Jake, I've always been struck that where you sit, you see both sides of the market, demand and supply. So I wanted to ask if you've seen changes in insurance around improving resilience around climate, or what you see as kind of big trends on either side of that market.
Sure. Like
Well, first, why don't we just reflect a little bit on what happened last week down in Florida, right? And just the incredible devastation that Hurricane Ian caused, which draws attention right to the issue right there. But that's not the only issue our industry has been grappling with. You know, over the past 5 years globally, our industry has been dealing with issues of flood, wildfires, extreme storms, and again, responding well. You know, over the last 3 years, there's been 300 billion losses to the industry, which is also sort of some unprecedented trends. Now, at the same token, we look at the other side of the equation. If our industry isn't picking up the bill, then often, right, the balance of that bill is falling to government, and they're grappling with some of the same challenges. At the same token, historically, they've relied really predominantly on taxpayers and debt to cover some of the bills associated with that. And now you're seeing macroeconomic issues at force with rising interest rates and inflation that's stressing budgets, as I think Jackie mentioned a little bit earlier. So, you know, I pause for a second just to point out to the crowd that, right, these challenges aren't lost on us. Our industries looking at this, they're concerned about issues with profitability, they're concerned with issues about climate change and the trends of losses. Yet at the same token, there are numerous practitioners in our business that are looking to lean in to try to address some of the challenges that are at play. Right, despite some of the challenges we've seen, the capital supporting the insurance and reinsurance business has been resilient. It has been holding up. And at the same time, we are seeing more interest in how our industry can lean in. Right, FEMA and the federal government has entered into reinsurance transactions with our business and our industry because they see the benefit that can bring. So longer term, we are actually optimistic that our industry and public sector can link up more functionally going forward and bring some good solutions to bear. And we're hoping like projects like we're working on with New York City will help provide a roadmap for others to follow. And we believe if we can set that roadmap up, there is plenty of interest in our business to lean in and take part and look to create some of these solutions.
Thanks, Jake. I love that idea of leaning in. And that's kind of the focus, I think, of our whole discussion, right, is to kind of help push that. So I appreciate that framing. I think one way the industry has been leaning in or has been given more opportunities, and maybe, Andy, you can correct me if you don't think this is right, but is through the kind of advancements we've seen in technology and the like tremendous explosion in data. And that's opened up a whole lot of approaches that maybe we couldn't have thought about years ago, a decade or two ago. So Andy, would you maybe talk to us about how you see data and technology helping here?
Yeah, absolutely. I mean, you're spot on that there's been a tremendous increase in capability, including now commercially private companies that are delivering an incredible amount of spaceborne assets to bring global scale to some of these data solutions. But there's a ton of advances both in ground sensors and airborne monitoring solutions, and all of these culminate to a constant monitoring capability and a lot better data to inform the trends and impacts from natural disasters, and also, of course, other civil security related, defense related things separately. But so the capabilities have advanced rapidly, and what they're providing is an incredible value proposition to go into places where previously data hasn't been available and provide financial resilience tools and provide enhanced response and recovery capability. And so I think we're a good example of a company that frankly started as a satellite design company, launched satellites, started operating them, and realized the potential of this hardware to really change the game. And so it's really important for us to bring this data both to support sophisticated nations and areas in monitoring and responding to events, but also to work with the insurance market to bring that resilient financial mechanisms like parametric insurance, which we've discussed, to these areas of interest. And there's a real potential at this point, not only to leverage the existing capital, the catastrophe capital markets and reinsurance market, but potentially to expand that as well as we look at bringing data to new types of risks and new areas of the world. So there's a real value proposition behind a lot of the innovation that's happening that is very relevant to helping communities and the insurance market work together. And so we sit at the nexus of those two, really to try to deploy capital in to inform resilience and recovery. And inform risk over the long term. So as we're gathering all this data as well, what we're doing is building a library of data over time. And so you can start to analyze risk in a different way that's potentially more accurate than some of the models that have been out there. But taking the observation-driven kind of capabilities that we bring and marrying them with modeling so that folks like Swiss Re and others can price the risk and model the risk and communicate the risk is something that we're very actively working on, and certainly excited for this project to explore that. And we have some other projects in African nations as well that we're working on. So bringing this capability to underserved cities and communities in those regions as well. So it's a really exciting time, I think, for a lot of this innovation.
Great. Thanks, Andy. Let's now try to weave all of these kind of comments together and talk a little bit more deeply about this project we've been working on together that we've all kind of alluded to. So I thought maybe I'd give a couple sentences, high-level overview, and then I know each of you can dig in on kind of different specifics of what's going on and maybe what the implications are. As noted, we have a project pilot in New York City. This is funded by the National Science Foundation through their Civic Innovations Program, which is a really innovative approach to try to link communities and researchers with actual real-world policy change and impact. So our project is designed to address this clear need that we found through some of our survey research, that lots of sources of post-disaster funding to households to face the huge expenses we know they face after any disaster events like we just saw with Ian, as Jake mentioned. But a lot of the funding to help cover those costs can take a long time to get to people, can take months before it's in people's pockets. And while more affluent households can cover that funding gap with their savings or with access to credit, we saw that low and moderate income households can really struggle with that and turn to coping strategies that can really lead to sort of downward financial spirals. And so we wanted to help get money to people quickly, flexible money to help prevent that sort of negative financial impact on a household. I'll also say we targeted rainfall-related flooding, which is escalating in the Mid-Atlantic region, and New York City saw a year ago with a couple very severe rainfall events that many of the population in the city that's at risk from that type of flooding aren't aware that they're at risk of it, aren't prepared for it, and are uninsured, which is a little bit different than the coastal areas where there's been maybe better and more outreach around some of the flood risk. And I should note, a partner with us on this is the Mayor's Office of Climate and Environmental Justice, and they've been working with the center on a lot of related and complementary outreach around some of these flood risks. So in this pilot, the Center for New York City Neighborhoods is going to be using the risk transfer markets to help finance an emergency grant program to help meet those immediate needs. So Theodora, let's start with you, and maybe you can talk a little bit about how the center hopes to be using these types of risk transfer tools to improve, recovery for the households that you work with.
Yeah, thank you for the question. I mean, you just summed everything up so perfectly, but I can add a little color. We really want to solve the recovery gap for low-income homeowners who, after a flood, as you mentioned, may not have the resources they need to muck out their basements or supplement their income or keep up with their mortgage payments while they wait for compensation or federal aid. And because flood insurance rates have increased substantially due to changes to the NFIP, it is an unattainable cost for thousands of homeowners. So we want to make it easier for folks to access flood insurance, to understand its benefits. So we're thinking through that by piloting a parametric flood insurance pilot program, as Carolyn mentioned. We're also determining the feasibility of providing vouchers to low-income residents to subsidize their flood insurance premiums and provide one-on-one counseling for homeowners. And I think the piece about counseling is especially important as these costs increase, because now homeowners need to work with somebody to understand how this will financially impact other household finances that they may have. We also think it's important to fund homeowners with, be able to provide homeowners with resiliency audits and elevation certificates, which are not only crucial adaptation interventions, but they can also reduce the cost of flood insurance. So with the pilot specifically, we're really looking to figure out how we can reduce the burden of paperwork, not have homeowners need to demonstrate whether they own their home or what their income is, to be able to at least receive money quickly so that we can demonstrate the need for a tool like this and a product like this in New York City. So it is a pilot. We're thinking small scale for now because we want to really get it right, but we're hoping that this is something that can be taken up more broadly in New York City for future flood events, which we know are just going to be increasing.
Thanks, Theodora. And I really appreciate the point that you stressed there that's kind of underlying the center's work, which is the insurance and the finance piece is just one piece of this bigger resilience puzzle, right? And it's so great that the center is providing all these other important aspects of those services for households to kind of make it all work together, right, for the kind of change that we need to see. So that's great. Andy, maybe we can pivot back to you to talk more about some of the data, because this pilot, I think I'm right in saying, is breaking some new ground with trigger design. I know that rainfall related flooding in a dense urban environment is a tricky nut to crack. So maybe you can talk to us about that.
Yeah, I mean, really just to, talk about current events also, really the capability that we're trying to bring is similar to what we're providing to FEMA related to Hurricane Fiona and Hurricane Ian, which just happened in Florida. And we want to provide the city and the stakeholders at play with real-time information as to depth and extent of flooding. And so, with Hurricane Ian, we were able to provide FEMA with insights literally within a matter of days after the flooding that as much as 300,000 buildings were impacted by flooding at varying degrees. And more than 20,000 of those buildings were affected at 5 to 8 feet of flooding potentially. So those are very material insights that can drive response activity, but also enable better characterization or reduction of basis risk around these parametric triggers. And so in New York City, obviously there's a very built environment, high density, tall buildings, which is typically challenging for remote sense driven solutions only. And so what we do is we bring in other open source data that we can crawl and gather about the event. We also bring in aerial driven stuff. So if somebody flies a drone or something of that nature, we can make use of that information. And in this case, what's really cool is New York City has a program called FloodNet, where they're deploying sensors throughout the city that will monitor flooding in real time. And so those sensors will be deployed throughout the city, and we'll be able to take that in as a data feed into our multi-source analysis and then provide this same type of insight in to support New York City. And so it will not only enable structuring of a trigger mechanism when flooding reaches a certain point or an area of interest or at a depth, it will also enable response and recovery activity for the Center for New York City Neighborhoods and others. And so, it's a really important dynamic for us. We want to have these not only be transactional from a financial resilience perspective, but also have data that's really actionable to help go into these underserved areas of the community and help them better respond and recover, because we realize certainly the inadequacies of the existing kind of relief programs in terms of low-income folks navigating that process. And so this is really about bringing the tools to help with assistance and help with financial resilience.
Thanks, Andy. Yeah, and I like the emphasis that these data and tools can be used in both the pre-disaster and the post-disaster. And that's so important to link those. Jake, let me turn to you now. And while we're all very excited about the actual pilot in New York City, as Theodore said, it's small, we're learning. This is a learning by doing, I think. And Jackie highlighted how you sometimes have to stress test these things with an actual disaster to see how they're working. So could you talk to us a little bit about how you think this might help replicate or expand or push other, similar projects forward elsewhere?
Yeah, I'd love to. And I just start by sort of echoing some of the themes that Theodore arose. When we were building sort of a concept about community-based cat insurance, we recognized finding a few pilots out there that could serve one as a roadmap, but also again, as Theodore, sort of lessons learned as you go through the process. Not just for the community in terms of how they can apply these, but also for our industry and other stakeholders in terms of addressing some of the challenges that are naturally going to come up. What we like about the New York City pilot is it's small, it's focused. We're going after a peril that's one of the most prevalent in flood. And we're focusing it on clearly sort of an at-need component of a community. But even more broadly speaking than that, when you consider flood and story after story about the lack of take-up and how do you bring insurance to bear in some of these areas, because that's going to be the tool that's going to be able to respond the quickest and help a community get back on their feet. There's also an ESG component to this, which is something that resonates with stakeholders in our place in terms of how we can take insurance solutions that are working very well in certain aspects of our societies and bring them to underserved components. So as we've stood up in New York City, we've seen, and as we've been around talking with other people, there's been interest expressed in what we're doing and how we're doing it and all of that. It just tells me right there that our ability to engage more broadly with other communities and use what New York City is doing as a very good example of processes that they could follow and bring to bear in their own circumstances. By the way, it was no different than when we were working with FEMA and the NFIP and helping them engage with our industry for the first time. There were all sorts of lessons and issues that needed to be tackled and overcome from just a federal infrastructure standpoint in engaging in financial tools that they hadn't thought to engage it with before. So again, to replicate this going forward, we see fabulous opportunity to take these kinds of solutions, these kinds of approaches, and then link them up with some of the acts that have been approved and put in place by the federal government. If you think about building resilient infrastructure and community program and the mitigation dollars that the federal government is making available to communities to strengthen their infrastructure, linking that with a more robust risk transfer solution around it, whether it be on flood or whatever the peril might be, will help improve that. Just in the last few weeks, the Community Disaster Resilience Zone Act of 2022. Again, another act that's been processed that's going to help focus in resilient related issues with communities that need. So there's plenty of interest and again, a lot of areas to make engagement. The fact that some of these solutions are starting small and then building out over time, I think makes a lot of sense because we've seen before sometimes people who try to take some of these solutions and make them too big too early, they can sometimes collapse under their own weight. So we like the concept of finding something, start small, make incremental improvements, and then expand and take unbudgeted issues and make them into budgetable issues that communities can manage to.
Yeah, thanks, Jake. That's great. And I think we're all really excited about pulling out those kind of lessons learned from a small pilot that can be expanded elsewhere. Jackie, let me turn to you. Swiss Re has been a leader in this space. So can you talk to us about how you see this as part of your broader efforts? And also maybe since you've worked with the public sector, how you see these partnerships really helping to drive solutions?
Yeah, absolutely. I mean, I think that, a lot of what has been said is kind of how we see it. So, for example, we do see this as a broader initiative, as part of our broader initiative, right? You have the scalability and replicability, as Jake said, about this particular product and testing it with other cities and areas that are focusing or dealing with the same issues. And you said, Carolyn, right, part of the reason why we do this is because of the financial challenges that these public entities face, right? So, and things that we really want to try to close that protection gap and help these governments be more financially sustainable after an event. And, Andy, to your point, which is interesting with respect to data and technology and the evolution, the innovation, it's not as much that, I think in general, you wonder how innovative insurance can be. I think our team sees the need for fast innovation, and we're hopeful that, even with this small pilot, that maybe we can start thinking about the questions of, can AI and machine learning help anticipate damage and the need for evacuation and mitigation and advance payments? Can we reshape disaster relief using data to prioritize payments in need, which is part of what we're trying to do here in New York City. And maybe on down the line, we can use kind of payment technologies, right? And claims experience to help get money to where it's needed most. So it has broader applications and things that we talk about a lot within our team. I think to your point of this public-private nonprofit, right, partnership, it's complicated. You see all the various partners represented here in order to bring this small pilot to bear. I think one particular example where we've seen real success in this area is in the area of where the insurance industry has been able to bring its existing risk knowledges and expertise, which is kind of the protection of our natural environment, right? The protection of natural assets like reefs, mangroves, wetlands, sand dunes, and then also kind of protecting the revenue derived from those natural assets and enabling green-gray construction of those natural assets, something that's being talked about a lot. And I think that these nature-based insurance solutions are similar to what we're trying to do here. Is it takes a variety of different actors to pull together to make these solutions possible, and a variety of different funding, grant assistance, insurance, recovery, et cetera, to make these happen. And one just kind of example that is, was a pilot, and it is slowly being rolled out to other parts of the world, is in 2017, Swiss Re worked with the Nature Conservancy and the government of Mexico to design a reef cover for Quintana Roo, Mexico, to protect the largest Great Barrier, or the second largest Great Barrier Reef in the world against hurricane. And the reason why we needed all these players to come together, and it wasn't just about ensuring or designing the insurance product, but it was also the payouts for that insurance product were used to protect the natural asset, the reef. But it wouldn't work unless you had kind of nonprofits participating in creating a brigade that would be on alert when and if the barrier reef was attacked and needed to go in and restore. So you needed the government involved, you needed nonprofits involved, you needed the insurance industry involved. And we've seen that there actually has been a payout as a result of a hurricane hitting the Quintana Roo Great Barrier Reef. And I think that we all know that this is an example of where kind of protecting our natural assets helps with the restoration and protecting with the restoration of the natural asset in and of itself, which is used to protect the viability of the economy for, let's say, the beaches along that area for tourism. So I think that all of these various examples are super important to demonstrate how we can all work together to create these products. And I think we all know it's not easy, but it is difficult, but the challenges are not insurmountable. And I think that we need more of these examples so we can show that it can be done.
Thanks, Jackie. You teed up perfectly where I wanted to take us into the next question, which is that innovation is not easy. And maybe when we're trying to harness risk transfer to solve social and environmental problems like you were talking about, it requires these complicated partnerships that you were explaining. It requires all these different people to be at the table. And that adds layers of complication and difficulty, especially if some of these are groups that aren't used to talking to each other or not already in collaboration and discussion. But hopefully with each new one, that's kind of expanding out. But I wanted to kind of, dig in on that a little bit and now spend some time talking about what some of those barriers and challenges are to building greater resilience or to using insurance to build greater resilience. So if all of you would maybe weigh in on that a little bit. Jackie, I know you started to touch on it, but I'm sure you have more things to say too. But Jake, do you want to start with you? And this is the time to talk about the hard parts.
And we reflect on this a fair amount. Why aren't we seeing more practical answer? And I think you've hit on some of these things. First, right? Fundamentally, it is hard to affect change, and I think people get stuck in their own constructs. They don't know where to go. They don't know where to proceed. I also think at times some of those old constructs, right, large government, particularly some of the larger cities that do have the flexibility via debt, via taxpayers, they haven't thought to engage in risk transfer. They haven't seen really the need. We would argue that just some of the trends that we are seeing on some of the challenges that we're trying to get at, I think we all have to start thinking about partnering differently. I think fundamentally there's also a drag to even how disaster funding works in this country around the Stafford Act sort of plays into that as well. And I would just encourage government to sort of consider some of the trends that we're seeing there, right? Routinely now, presidential disaster declarations are numbering well over 100 each year. And while we absolutely all concur and see the need when it comes to something like a Hurricane Ian or some massive event, I think we can all agree that we're not seeing, right, over 100 a day. We're not seeing one of those every third day. So the reliance that's being placed on that one avenue, I think needs to be rethought. Right, you got to start somewhere. And again, we've hit on some of these things before. What I like about New York City is it starts, and the project there, it's starting small. It's taking one small component and working to a practical solution. Not a study, but they're actually engaging in finding ways to make these partnerships work and doing it on a small scale so that it doesn't get bogged down with too many stakeholders that can either delay or make something take too much time. I think we all got to find ways to move faster. And there are regulatory issues, as we know through this project that we've encountered. How to take some of these new approaches and have it fall into the framework of insurance versus derivative, and how do you unlock not only the capital our industry can bring to bear on it, but then also some of the beneficial tools in proper and more robust risk management. Those anyway are some of my thoughts in terms of some of the things that need to be tackled so that we can move quicker and more robustly down these paths.
Thanks, Jake. Do others want to weigh in on that?
Sure. I would just say, I mean, we echo a lot of what Jake said. And as you can kind of tell, we have these conversations often, right? Because we want to try to figure out how do we get over these hurdles in order to do more projects like this. So we're constantly trying to figure out how we as the insurance industry can do that. And I think, Carolyn, by you pulling this panel together, part of it is education, right? I think that that's what we're trying to do is educate kind of what is the value, in particular with New York City, the value of parametric vis-a-vis the traditional insurance that they have, and the flexibility that it provides, and the speed of payment that it provides, and how it can be kind of complemented maybe with payment distribution capabilities as well, so that it can get to individuals who need it most. So I think that a lot of it is around getting individuals to think differently about what insurance can provide and risk transfer can provide, and getting them to view it complementary to maybe the traditional ways that they would fund disaster assistance, whether it's through fundraising philanthropically, whether it's through debt issuances on the capital markets, or just traditional disaster assistance coming from the federal government, or at the end of the day, their rainy day fund being swept away, and getting individuals to see education and getting to see that insurance or risk transfer should be part of the overall financial health of what they're looking at and part of their risk management strategy. And so there's aspects that do look at that, the risk managers, but I think you need to get more individuals who are really looking at a total risk management strategy and how we approach these issues. But I think we are all aligned and what the challenges are. The question just is, how do we work together to educate others?
Yeah, absolutely. Thank you. Theodore, I want to give you a chance too to say from your perspective. I think I'm right that this is pretty new for your center to be engaging in these markets. So yeah, go ahead.
Yeah, absolutely. And if I could just speak from the homeowner perspective, and to Jake's point and to Jackie's point, really relying on the expertise of folks in the insurance space to educate homeowners. But I think the benefit of being a nonprofit is that we really have these connections to the community. The center has a network, we call it our network partners. It's an umbrella group of over 30 agencies around the city, from housing counselors and legal service providers, who counsel homeowners on everything from flood insurance to refinancing their mortgage. And so being able to have that connection, I think, is really where that education and base building happens. So I think, back to your original question, the lack of practical engagement, I really think comes around that education and outreach. We really need to provide tailored outreach and education to low and middle income homeowners, Black, Brown, immigrant communities, homeowners in older housing stock. I think after Hurricane Sandy, there was this, emphasis on needing to, educate folks on the coast of what their flood risk was. But inland communities, I think, were really overlooked, and we're constantly learning. But now that we know what the risks are, I think providing that education is going to be incredibly important. And sorry if you just heard that bell. I think that, frankly, there is also a lack of trust in institutions and government agencies to really do right and have people's best interests in mind. Folks on this call may know that the New York City Comptroller's Office denied all 4,700 claims that were filed against the city by New Yorkers after Hurricane Ida, based on the fact that the sewers were not intended or designed to have such an inundation of water. All of the claims were denied. But when you're a low-income homeowner, maybe a senior on a fixed income, or you have a low wage or a low salary, and you have thousands of dollars of home damage, I think it's really, really hard to have faith in that system. So I think, that was not the response that we wanted to see. I think New Yorkers deserve better. And so I think trust needs to be established from the top down in order for any intervention to be effective.
Thank you, Theodora, for providing that perspective. It's really important that we keep centered. Andy, do you want to weigh in on this too?
Yeah, yeah, absolutely. So, in terms of challenges from a data or solutions provider perspective, we really need to see this community lean in and engage both with risk capacity providers and brokers like Swiss Re and Guy Carpenter, but also really lean in with governments and nonprofits to get them familiar with these solutions, because a lot of these solutions are new. And we've built our natural catastrophe monitoring solution for flood over the last year and a half. And so for us, it's critical that we go in and deliver this data to governments so that they can start to get familiar and understand what this data can actually bring to them from a response and in a resourcing perspective. But also, I have to commend Guy Carpenter's public sector team and Swiss Re's public sector team in leaning in to get after how can we model and price this risk so that the market will embrace it. And it's a really important thing. And we don't have the benefit of 20 years loss history or 20 years flood history, rather. And so what we need to do is create that over time. And so for us, consistent capture of flooding and engaging with our government partners on response and recovery is really important so that they get what these solutions bring to them. And while we're there with them helping on response and recovery, we can also blend in the narrative around this could potentially transform how you deliver assistance. And we're seeing that with so many of the agencies that we work with already, where they're looking at the data and saying, man, we could really do a lot with this in terms of delivering faster for underserved areas. And so being able to tell that information in real time as to the impact is just really critical. And I think data and solutions providers really need to lean in with these organizations to help go at this from both ends.
Thanks, Andy. That was helpful and started to anticipate my last question as we're nearing the end of time. I wanted all of you to just share maybe one or two things or steps that you think would be most impactful in sort of changing the landscape. What are your priorities or your dream list of what you'd see starting to happen? Just on this bigger topic of building resilience to our escalating climate extremes. I'm not sure who wants to start with that, Andy. I don't know if you started to say, I feel like in that last response, some of those dream items and directions you thought we should go. I don't know if you want to expand on that, and then we can let others go.
Yeah, I mean, and Jake touched on this earlier. When we talk about the U.S. context, what's really important is federal support for these types of programs. And so the Building Resilient Infrastructure and Communities program is a great step. However, I think the aperture needs to be opened even further to look at assistance programs and other engagements that FEMA and other agencies have at the state level with survivors. I think there's a tremendous opportunity for support for these types of programs, not in paying the premium on behalf of states and locals, but rather in helping with the setup, structuring, and cost sharing, all these pieces to make these deals happen. And there's a great convening power as well that FEMA has to bring stakeholders together and talk about these issues. And so it's really important that we do see a top-down approach to some degree, where there is support for these programs. And I think, I'm optimistic by some of the reforms that he mentioned earlier as well. But I think having the public policy framework really start to support this, and a willingness to digitally transform things like individual assistance and, other assistance delivery at the local level is really important. I would also say that I fully support the idea of looking at this as at the regional level. I understand that a federal approach doesn't necessarily fit every environment. So risk changes in its nature as you go up and down the coastline or inland. And so I think creating environments where locals can be engaged, communities can be engaged is just critically important.
Thanks, Andy. Jackie?
Sure. Not surprisingly, coming from Swiss Re, I'll take a very pragmatic approach to what I think is needed. I think more pilots or partnerships like this, right? More entities like Theodore representing the Center for New York City Neighborhoods kind of stepping up and saying, we want to be part of this innovation. We really want to see how we can work with the public sector, knowing that there is that potentially lack of trust, right? On behalf of you representing those of the citizens that you want to serve, protect, and make sure they're resilient. So I think we all need to, we want to see more pilots like this to demonstrate the theoretical that we have, that this is actually going to move the needle. And I think to Andy's point, we always see that sometimes federal change, right, and policy and regulation comes from the state and regional level, and showing how we can really make a difference, and then kind of from the bottom up, maybe shifting the entire apparatus. But yeah, more pilots and cooperation.
That's great. Jake, you want to weigh in, and then Theodora will give you the last word.
Thanks. So let me just start by everyone just consider, right? FEMA and the NFIP has finally decided that, hey, it's a good idea to partner with the private sector, a large federal U.S. agency, and they're doing so. They're routinely telling everybody that flood insurance policies are the best way for homeowners and businesses to get back off their feet when devastating floods happen. Now, if you just link that up and think, how powerful would it be if more large cities like New York City and others, and it's great what this project right now we're working on, but other large cities and other states started acting the same way. And the powerful message that, our elected officials leading by example, what a long way that would go to dispelling some of the myths out there that the federal government will be there to help me after an event. So yes, more pilots, more engagement, but I believe very strongly that our public sector and our elected officials have to affect change in the kind of policies that's necessary so that we can all move more quickly down these paths.
Thanks, Jake. Theodora, over to you.
Sure. And I just want to echo everything that Jake, Jackie, and Andy have all said. I'm really excited to be part of this collaboration. And so I think we are moving the needle, and it's really, really exciting. I think from if I can just take it down to the very minutia, at least for homeowners, and what we would like to see as a nonprofit counseling people in New York City is, like I mentioned, more outreach and education specifically to inland communities with regards to, severe rainfall, lowering the burden of proof and paperwork when it comes to filing a claim, because that's really a very difficult thing for many people. In order to obtain that financial assistance, I think that would significantly improve recovery, lower flood insurance costs, frankly, or if we can't do that, what are other sort of innovative ways that we can supplement that cost for people so that they are covered? And then finally, emergency, no strings attached funding immediately after an event. Because I think the bottom line is that we need to increase our investment in communities, both in disaster preparedness and recovery. So
great, thank you. Perfect summary. Thank you so much to all of you for being here. I feel a lot of optimism knowing that all of you are on the case helping solve these challenges. So thank you all again.
Hello, I'm Lieutenant Governor Susan Weissowitz, and I'd like to thank Commissioner Andrew Mais and the Connecticut Insurance Department for hosting the Connecticut Conference on Climate Change and Insurance. This is an incredible opportunity to have a conversation about the very real and present consequences of climate change and how the state of Connecticut is working to address these issues. It's also an opportunity to prepare the private sector on how these challenges will affect the market and our communities. Connecticut's geographical location makes it front and center in the climate change conversation, as nearly half the state is on the Atlantic coast. In more recent years, we've seen the effects of climate change disaster through tropical storms and hurricanes threatening our coastal communities with severe flooding and property damage. With the impact of those storms in our collective memory, Governor Lamont and I have committed to making a cleaner and healthier Connecticut for our residents now and for future generations to come. During our last legislative session, we worked hard to pass climate change laws for the state that are both fiscally responsible and optimistic. we signed into law two major initiatives: Senate Bill 10, an act concerning climate change mitigation, which would fully transition Connecticut's electric supply away from relying on natural gas and oil to power its electric grid. This went into effect this past summer on July 1st. This law will lead to changes under the Connecticut Clean Air Act to establish sweeping new electric vehicle and air quality improvement programs within our state departments. We've set a target of 100% zero emission school buses for all school districts by 2040. The second major climate change bill, Senate Bill 176, an act concerning clean energy tariff programs, expands existing programs supporting renewable generation or small renewable generation that is located on site and will reduce the energy burden for many of our consumers. Connecticut is a leading state when it comes to mitigating the impacts of climate change. Our new laws will help to further accelerate progress on our greenhouse gas emission goals. They will reduce the costs associated with renewable energy programs and providing more equitable opportunities for low to moderate income families to invest in a cleaner environment for themselves and their communities. Thank you for all your commitment to making a brighter and more sustainable future by attending day one of the Connecticut Conference on Climate Change and Insurance. I hope you'll be able to join us for day two tomorrow, where we will continue this important conversation. Thank you so much.